Perhaps untouched. Is that true today, where so much of that accessibility to U.S. defense manufacturers may be in question? Of course, mining stocks very much in focus, Guy. Of course, we have one eye on what's going on in China. They're talking about perhaps stabilizing the market via the currency, et cetera. That might be reflected in the mining stocks this morning.
Okay, Credit, that wraps things up. Let's get into the opening trade. We are waiting for Monday's trade. How ugly is it going to be? Let's take a look. We're expecting some ugly numbers to be posted. Right, here's your opening trade. Let's dig into what we are seeing right now. FTSE 100 expected to do better this morning, but it's already down by 0.2%. It's expected to open. It's expected to stabilize significantly lower than this, say maybe down by 0.3%. 600's out of the gate, down by 0.6%. You could see this much worse. You could see kind of 4% down. So FTSE down maybe 3%, Stock 600 down potentially 4%. We need other markets to open. This could be a very slow market to open this morning across Europe. We are expecting big losses in big markets like the DAX. The IBEX, Credit mentioning what's happening in the Spanish banks. That sector, that market is already down by 3%. We'll see whether that accelerates to the downside. The FTSE is now down by 2.2%, 2.3%. We're expecting the CAC to open sharply to the downside this morning. The DAX will be the big one. Wait and see exactly how German stocks are being affected. You've already seen a big move in Bunds this morning where we are catching a bid. That tells you about maybe where the flows are moving as well. So that is the picture thus far. I think it's going to be a fairly torturous process maybe to open these markets here in Europe this morning. Bid-ask obviously coming together quite slowly as we await some single stocks that are quite hard to price, Credit. So what are you seeing in terms of the sector story?
Well, Guy, the market is open. At least the Stock 600 is open, and not one stock is in the green. I'm seeing a series of flat. I'm seeing a series of unchanged. We're seeing a lot of liquidity come through this market as well, but all to the downside. You can see it on your screen there. Still, the market trying to digest what you're trying to actually see. When you look at the downside, though, some of your index contributors to the downside right off the bat are a lot of the biotech names and a lot of what are in your kind of core six as well. Plenty of volatility halts showing up in this market from the banks, SocGen, Deutsche Bank, for example, among many, many others. So again, I think this takeaway this morning, while we're waiting for this to all shake out, is simply that the markets don't know what to do. There's a plumbing question here as well, and that's what we're trying to navigate right now.
I think the markets do know what to do. You sell. That seems to be the narrative this morning. But as you say, in terms of where the losses are coming through, it's fascinating. So the biggest points drop this morning, and much of this market is still not open, is Nestle, which is fascinating. Yeah. In some ways, that should be the safe haven in this trade. But it's the fact that Nestle is getting hit as hard as it is this morning. Nestle is down by nearly, well, it's 3.5% to the downside. That should be the area you run to and hide in.
Yeah.
Nestle is dropping sharply, but now we start to get some of the bigger names coming through. SAP is down by 6.7%. You've got LVMH down by nearly 7% this morning. As you say, some of the farmers are down really hard. But the fact that Nestle is doing as badly as it is tells you a lot about market sentiment.
It tells you a lot about market sentiment. It also tells you about the underlying dynamics of this market, which is that there are a lot of firms out there dealing with margin calls right now. And what happens with margin calls is you sell your most profitable trades. And even though in the States, a lot of that has been the Mag 7, and it's been the outperformers there. Here in Europe, that defensive trade hasn't just been defense stocks. It's been, to your point, consumer staples like Nestle. So it's unsurprising that that's perhaps the first place where you would want to unwind and take some profit.
Allianz is down. SAP's down hard. Rheinmetall. Just need to check my numbers here. Rheinmetall is telling me it's down by 27%. Okay? That is a stock that's had a massive bid attached to it. I would just want to check exactly what's going on there and make sure I'm not looking at something odd and erroneous. But Rheinmetall is down 27% on my board at the moment. That has been a stock that has run up hugely. If you're talking about forced selling, maybe that is an area that maybe that is coming through this morning. So you've got Novo Nordisk down by 7%. That stock's been under significant pressure for quite some time. The DAX is down 9%, folks, this morning, as some of the big names that we've been watching very carefully of late come under significant pressure. So Rheinmetall, that stock has been on a huge run. It's got a volatility interruption right now. I want to check the GP in terms of what is happening here, just to get a sense of that drop. This was a stock that hit the high of 14.45. It is now this morning trading at 9.33 on the board that I have in front of me, but it's not trading. There is a volatility interruption on that stock.
Volatility halts across the board. What does that tell you here? Where the markets are still digesting, there is no, it feels like there's no buy the dip sentiment anywhere where you look, but that DAX move down a whopping 9%. I'll match that up with CAC, for example, down 4%. We're looking at some of the other indexes around Europe, circa 7 to 8% as well. I think now is the perfect time to bring in a markets guest who can perhaps navigate this a little bit. Poor Ben Guttridge, portfolio manager at Invesco. We put him in the hot seat. Is that what this is? It's just sell, sell, sell until when?
Well, just sort of trying to deal with my nausea after your sort of open there. It's a really, it goes without saying, it's a really troubling and difficult period for investors, and a catalyst that might invoke some sort of turnaround you'd think would come from policymakers. You know, it doesn't seem as though, I mean, that seems quite a distance from certainly the US administration and the Fed policy. Again, got their hands tied with the inflationary challenges as well, which doesn't seem there's an emergency cut coming from there. So look, it is hard to say with any conviction that we're going to get like a reversal in stock markets at this moment. Recessionary risks on the rise, but look, there are as you know, as the world grapples with US trade policy, but there are reasons to believe that, you know, a bottoming may not be a million miles away. Why there might be some good days in amongst some bad, and that sort of centres on the hard data.
What causes a bottoming? What causes the market to stabilise?
Well, I mean, it's the hard data, the survey data, the guidance from businesses and consumer sentiment, you know, is challenged. It's the hard data.
We saw hard data on Friday, the payroll number. It was really strong. The market continued to sell off. Yeah.
Well, I mean, it is at the moment, you know, all eyes are on, you know, trade policy and how this is going to impact growth, and there is very difficult analysis there because the duration of the trade spat. The degree to which things may be resolved, these things are very difficult to forecast, and therefore you're seeing this sort of bloodbath in markets at the moment. But yeah, you know, if you get decent earnings performance and you know, the economic data, the hard data, you know, can continue to stay resilient, then that could feed into some dip buying. Obviously, we've had a material valuation adjustment as well, which could attract investors. But I'm not saying this is like a fantastic opportunity. I'm just sort of alerting that there could be some good days in amongst the bad here. But certainly, investors should brace themselves for continued, you know, volatility and challenge from stock market performance.
You use that keyword valuation. I think it's really fascinating because in 2020, in March of or February of 2020, when that COVID-driven sell-off started, the conversation in January of 2020 was that the market is overvalued. This market is going way too hot for a very long time, and that even though COVID was, of course, a global risk, you were combined with that idea that the market was already overinflated. And I'm kind of having a little bit of deja vu now, and that, yes, we're talking about recessionary risk. Yes, we're talking about this massive kind of shock to the system, but we're entering it at a time when the market was already thought of as overvalued. So I guess I should say, what is fair value right now for this equity market?
Well, yeah, there is certainly the valuation risk was more material coming into this sell-off. We've seen some adjustment in that and could well see some more. But things that might offer some positive adjustments to the fair value is that we're not sort of seeing sort of level of private sector imbalances either. You know, I wonder whether you think I'm clutching at straws here, trying to you know, extract some positives. But you know, the jobs market is in reasonable shape at the moment. Consumer balance sheets are in good shape, and the relationship, as the Fed chair has articulated, between survey data and sentiment data versus transactional data isn't perfect. You know, if people need something,
Yeah.
they can afford it at the moment, and the jobs market, you know, perhaps that confidence is ebbing, but at the moment, not compelled them to save dramatically more. So, you know, look, I think with the private sector and consumers still in reasonable shape, you know, that could offer some positive adjustment to fair value.
Well, speaking of positive adjustments, Ben, we are looking at a market that is still shaking out. We are looking at volatility halts, specifically around the banking sector. Our correspondent, Valerie Titel, telling me here that 19 out of the 28 banks in the banking sector or in the banking index are still halted. And as they come out of the halts, there are some massive declines here. We're getting banking earnings in the States on Friday from likes of JP Morgan, et cetera. Do things like extra loan loss provisions, extra liquidity, stopping acquisitions, stopping buybacks, those kind of messaging from a lot of these corporates issue confidence in this market, or do the opposite?
Well, I mean, if you get that collection of things, you would think that should offer some confidence, you know. But you know, markets looking at a lot of things at the moment, and eyes more squarely, I guess, focused on trade policy. I mean, that's that type of data that could offer some support, and I guess given the dramatic, but it's how much credibility the market extends it, because things have happened a lot in the last, you know, the world seems to have changed quite a lot in the last sort of week or so, and how much that is reflected into, you know, banking provisions, how much loan loss provisions would they release into the market. Perhaps they might sort of, you'd think they might want to be a bit more cautious about that, given what we've seen in the past few days. The market might not extend quite so much credibility, but you know, a decent earnings season, I think, is going to be helpful. It's just how helpful.
Do you stay invested?
Yes, he says. What do you think about the hesitation in the delivery there? Is that a bit of a read? No, I think you know. I mean, it depends on time horizons. You know, we have an 18-month, 2-year time horizon for most of our portfolios. So, you know, I think that a lot of pain has been taken, and I think there is scope to stay invested here, but the marginal moves, you know, should be, I guess, getting longer bonds into portfolios, longer dated bonds into portfolios.
Cash?
No, I don't. I think longer dated bonds would be a better hedge against equities, recessionary risks than cash at the moment. I don't think the inflationary challenges are so daunting that cash is the right answer.
Longer dated bonds, that's a very kind of bearish recessionary call. What kind of timeline are you looking at for that to pay off?
Well, I'm hoping it doesn't pay off on the basis that, you know, we avoid recession and therefore long-dated bonds.
But if we were to get a recession, when would it show up?
Well, I guess you sort of. I mean, it could begin in Q3. It could start in May. I guess is the like recessionary. You know, that is when recession could I guess begin, but more like Q3, Q4. Yeah. As the recessionary call. But you want to move in advance of that. You know, so longer dated bonds look like and remain the best hedge against an equity market position and a hedge against recessionary outcomes.
Ben, when you talk to your peers, when you're sitting around the table at the moment, what are you guys talking about? What are you watching for? Which areas of the market are you looking at? Are there any signals that you're concerned about? Is there a liquidity story here that I need to be concerned about? Just give us a sense of. You can. I talked about this with Bono earlier. There's a macro story. There's a top-down kind of what the heck is going on? What's going on with the trust? But there's now a market internal story, which takes on a life of its own sometimes. And I'm wondering whether we're at that point yet, and it feels like we are. But what you're watching within that, is it the VIX? Is it what is going on within the market that you're keeping an eye on?
Well, I mean, it's from the top down, it's labour market data that would give us the greatest anxiety about recessionary risks. As we saw, the jobs numbers was actually relatively
within the market.
But within the market, well, I guess to round out the macro data, you look at things like challenger numbers to look for material weakness in labour market. But within the market, we're talking about US exceptionalism and the threat that's presented there, and the idea that these events, US trade policy and international policy, may be bringing Europe closer together, and that cohesion could be a nice story, tailwind for European equities.
Ben, great to see you. Thanks very much indeed for stopping by on what is a tough morning, I suspect. Ben Gutteridge, Portfolio Manager at Investco, thank you very much. The VIX is about to open. It should be opening in the next couple of minutes, so we'll get a read on where we were. Remember, it was up plus 50% on Friday. Core 6 looks like this. Let's take a look at the centre of gravity here in Europe. You've still got a bunch of stocks that are not open right now in terms of the stock 600. So getting a read on what is happening here, I think, is really, really difficult. So you've still got an awful lot. Let me just get you a number here. So unchanged, we've got 51 at the moment. Down, you've got 550. Critty? It's not a single stock in positive territory in Europe. Like, not a single stock is up in Europe this morning.
Despite several gaps lower across major benchmarks, across the S&P 500, when we've seen this in previous iterations, we've seen buy the dip, and there is no evidence of that this morning.
Absolutely. Let's talk about where we're seeing really some of the biggest action this morning. Defence stocks, some of the pharma names. Joe's here with the details.
So we are seeing some absolutely sensational moves in the defence stocks this morning. Guy, take a look at Rheinmetall. We're down 18% on that stock at the moment. It was down around 27% at the open, coming up very slightly. ThyssenKrupp, Leonardo, Airbus, all of those in double-digit losses. Leonardo just gone into a trading halt. Now, traders telling me in my IBs that people are cashing in, trying to make up these margin calls very quickly this morning. And also there's reports out of the US that Howmet over in the States potentially declaring a force majeure on some of its supplies, and therefore that is reading through into Europe today. And also the bank stocks, I had my eye in particular on Stanchart, because we were down 17% over in Hong Kong. We're seeing losses of around 8% for Stanchart at the moment. Not quite as big. Potentially there was some catch up from Friday, but also UniCredit just going into a trading halt as well. So much volatility in these markets at the moment. Barclays down another 8%. Bear in mind that index was down 10% on Friday as well. And another sector hit hard is the miners. We saw weakness across commodities overnight. Copper was down around 3% on the US trading. Also, iron ore was weaker. Oil, of course, coming down as well. So therefore, we're seeing these London-listed miners hit once again. Losses around 5% across that sector. And even Anto down around 6% at the moment. Big declines for that sector. And then staying in the commodity space, we have got a bit of an update from Shell. A huge move lower in that stock. They do have a trading update saying that they are potentially going to be producing less gas than expected, but this really seems to be a broader market move with the oil price decline really hitting that, but probably not helping on that trading update from Shell. And then finally, to finish back on Novo Nordisk, news over the weekend that the US potentially rolling back Medicare support for obesity drugs. That was announced under President Biden. Does seem to be an extra weight, but again, everything's selling off. Defence, healthcare, all of the sectors in the red today. Novo Nordisk, though, one of the big decliners by a points basis in Copenhagen.
All right, Joe Easton from our equities team walking us through some of the carnage that we are seeing in this market. As he was chatting, I was just keeping my eye on this bond market. Guy, massive moves across every region, across every curve. To me, what's standing out is some of the spreads here. The Oak-Boone spread back to 83. We were at 75 on Friday. Same gigantic, about 11 basis point move when it comes to BTPs versus Boones as well.
Stock 600. So Stock 600 peaks in 99 at 400. 2007, it peaks at 400. We're now trading at 466. We've come down really, obviously, quite sharply off a peak, was kind of in the mid 500s, 530, somewhere around there. Yeah. 400 is going to be a really interesting line. If we get anywhere near that, which is obviously a long way from where we are now, but the current trajectory, the rate of change at the moment is very, very ugly. Kind of where does this market find support? Where does this market find some sort of respite from the selling that we are seeing right now, which is aggressive? Volumes obviously are picking up quite sharply. This is a market that is selling and selling hard and is going to ask questions later. When do the questions start to get answers? I don't know at the moment, but there's some really interesting levels out there at the moment that could be watched very, very carefully. But at the moment, it feels like indiscriminate selling. Well, maybe not indiscriminate selling. People are selling defence stocks. The areas you've seen gains in are what is being hammered this morning. That tells you a lot about what's going on below the surface.
Absolutely. And of course, we are still, I think the S&P 500 closed at minus 17% as of Friday. We are looking at bear market territory. Futures are trading at 48.79 approximately over in the States. The bear market level, I'm told, is 49.15. So futures already expecting us to breach that level when it comes to the U.S. Open in just a few hours. It is grim out there, folks. Selling across the board. Stick with us. We're going to have you covered. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
21 minutes into the session, and folks, it is very, very, very ugly out there this morning. We are seeing a huge risk-off move, and it is being reflected in stocks. It is ripping through other asset classes. Europe is down hard, as you can see. Remember, this follows on from the big losses that we saw at the back end of last week, Thursday, Friday. You are seeing it ripping into other markets as well. The VIX has just opened. It is up 29%, 30% this morning. We are now trading with a near 60 handle. In fact, a moment ago, we did have a 60 handle on the VIX. We are trading at 58.85. That's an indication maybe of the fear that is out there this morning. You are seeing European banks under pressure. You are seeing people selling what has done well, very well recently. The defense sector is being absolutely decimated this morning with some huge, huge losses, Critty. Look at names like Rheinmetall. When it opened up this morning, it was down like a quarter. We're coming off those levels, but it is still an ugly move in that space.
It is still an ugly move and still no sign of respite. Let's go to the oil space as well. We are seeing quite a bit of movement as well. We are now seeing NYMEX trade below $60 a barrel. Brent still at a 63 handle, down a whopping 4% on both levels. Let's bring in an expert here. Bloomberg Energy reporter Stephen Stepchinsky joins us this morning. Stephen, this oil market responding very much to the growth scare. How low can it go?
Well, according to Goldman, it will go to about 62 Brent by December. But they've reduced their outlook 2 times in the last week. So maybe they're in for a hat trick. Who knows? I think what we really need to focus on is actually, you know, what happens in terms of demand, in terms of consumption, in terms of recession. I mean, this is clearly just following the overall sell-off in the market, this risk-off appetite. So when will we see the bottom? It's not 100% clear, but I think we might get to a point where, if you're talking about fundamentals, shale drillers are going to have to start pulling back rigs. So if we're getting to that point, which won't be anytime soon, it could take weeks or months for them to reduce their output. When you start to see that, I think that's when you're going to begin to see a recovery in oil prices.
Separate out for me Trump and OPEC. What effect are they both having?
I mean, it's supply and demand. So Trump is potentially the demand side. His tariffs and the retaliation from China are threatening the global economy. That could reduce energy demand, and that reduces consumption of everything from oil, gasoline, and other products for the fuel. At the same time, OPEC Plus is adding supply to the market, which is sort of flooding this already weak sort of situation, adding to the bearish element.
Stephen, great to catch up. Thank you very much indeed. Let's bring in Valerie to get a conversation on around what is happening in the other asset classes. Banks are being hammered. European banks are being hit and hit really hard.
Yeah, if we look at some of the banks at the bottom of the basket, I mean, Commerce Bank down nearly 10%, SocGen down 8.5%, Deutsche Bank down 7%, and this is just compounding losses from Friday. The SX7E over the last 3 sessions is now down 20%, and we're seeing this happen in tandem with credit spreads moving wider. I'm looking at high yield spreads gapped wider on the open. This is a very nasty session when it comes to credit risk. We're even seeing that dynamic happen in the government bond space. We're seeing a big rally in Germany, but what's left behind? Italy, Spain, Greece. This is a credit widening event, and this is not a good time to take any risks here in Europe. So I mean, obviously every market is panicking here. Every single one. Why is euro-dollar up at 110 right now? And how sustainable is that? Yeah, good question. I mean, FX has been kind of the market that's been confounding people of late. We haven't activated that left-hand side of the dollar smile, seeing a big move into the dollar on risk off. We haven't seen that. We're not seeing that today. The Bloomberg Dollar Index is down 0.25%. So that's a big question over, if is FX really the barometer for markets here? I don't really see that yet. Where I'm looking at is developed market credit spreads, because we saw the widening in Asia as well. Look at some of the CDSs on some of these Asian nations. Their economic model is put into huge question, and I think people are starting to bridge that with Europe as well.
Defense stocks are being sold hard. What does that tell me about people's portfolios right now?
In a lot of pain. But to be honest, I don't think defense stocks is what I'm watching as the barometer. Those are stocks that have outperformed so far this year. But I'm looking for where in the market are we pricing?
But is there forced selling going on?
Yes, perhaps. If you look at what's going on with gold, it's kind of telling that as well. We're down another 0.5% in gold, and that happened last week because that's where people have been selling in order to access some liquidity. If you're down a lot on positions, you're getting margin calls. You have to hit your winners, and that's what we're seeing today. You're seeing that on the tech space as well. And we should mention that, again, back in the futures picture in the U.S., down whopping 5% almost, as is where we're at. Bloomberg's Valerie Teitel walking us through some of these markets as well. The response function, guys, is going to be crucial here because we are still looking at a bond market that's continuing to tank. 390 on the yield. I say rally, the yields are continuing to tank. 390 on the U.S. 10-year.
The assumption has to be that Europe is not going to respond aggressively at the moment. That's the language that we're getting, yet European stocks, risk assets are being sold and sold hard. What will this look like if Europe does respond? Yeah.
Is this the catch-up trade to Friday, or is this the setup to today? That's the question for a lot of these equity investors. Coming up, we're going to talk about that European response as EU trade ministers meet in Luxembourg. That conversation next. This is Bloomberg.
Statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right. And market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump. And if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
With 30 minutes into the trade, I think we're going to call it Ugly Monday at this point. There may be other, maybe more color-related adjectives describing this very, very shortly. The Stock 600 is down by 6% this morning. You've got the DAX in Germany down by 7%. The CAC is down by nearly 6%. The FTSE 100 feels like a relative laggard in terms of the selling that we're seeing this morning, down by a mere 5.2%. The selling is ugly. It is across the board. We are seeing certain key sectors firmly in focus. People are clearly having to sell what has done well recently. You can see that very much in the defense sector. You are seeing some big names being posting some very big losses this morning. Rheinmetall is down by 13% now. It opened up much worse than that. We are seeing a bid maybe coming back in a little bit, but it's still down heavily on that trade. ThyssenKrupp is down by 12%. Leonardo still is not open yet, folks. We have not opened Leonardo this morning. Or we don't have it open right now. Airbus is down by 10%, circa 10%. As we were hearing a little bit earlier, a supplier, part of the supply chain for the aerospace sector has called force majeure. That is going to have a big ripple effect throughout the entire space, so keep an eye on what is happening there. So that's what you are being forced to sell this morning. Let's take a look at the banking sector, because this is the epicenter of the story, as Val's been pointing out this morning. It is the relationship between credit spreads and the banking sector that is worth watching. Standard Chartered, HSBC, Barclays, UniCredit, some of the biggest names in Europe are down 7%, 5.5%, 9%. Barclays is down 9% this morning. UniCredit is even worse. It is down by nearly 10% this morning. It is down by 9.7%. There are some big, ugly losses in a number of key sectors, and we are watching them all very, very carefully. You want to know what's happening in terms of the risk gauges? Let me show you what is happening with VIX. Remember, a 50% move Friday. This morning, we get a huge move as well. We spike higher. We are north of 60 right now. We're not north of 60. We're at 59.18. We're just below 60. We got north of 60 on the VIX. A big leg higher in terms of this market metric this morning, which is also worth keeping an eye on. You don't see these kinds of levels very often, Critty.
You definitely don't see these kind of levels. Let's talk about where the money is flowing to, where the fund flows are flowing to, and a lot of that is going straight into the bond market. Take a look at these massive moves you are seeing on both sides of the Atlantic. I'm going to start bottom up here. The 10-year is now seeing a 10 basis point move over in the States, 389. We are sub below 4% and by quite a bit of a margin. A bigger move over in Germany, 12 basis point move lower. Now, this is crucial here because you are seeing a bid across the curve, across regions, into a bond market that still has to digest the inflationary impulse that these tariffs may be bringing on both sides of the Atlantic and even across the Pacific as well, which brings me to a chart that caught my eye. I want to bring it right back to the equity market because as you see this move lower in yields, in theory, financing conditions should be easier, and yet the uncertainty stops that, which brings us back to the first time in about about 2-3 years that we are seeing over 15% drawdown in the S&P 500. That is what we are counting down to the U.S. Open in just a couple of hours. Even though we are 30 minutes into Europe, we are seeing the bloodbath. It looks a lot like the bloodbath we've seen only 3 times since the COVID crash. Let me walk you through. I'm going to take a time back into history here, where we go back to 2020, March of 2020, the COVID crash, that massive drop. It took about only 5 months to rebound. So if you're asking how long the sell-off is going to last, if that is your indication, only 5 months. I'm going to speed it up here to 2022, where, of course, you saw that major bear market, the one year that you in last, I would say, 10 or 12, where you started to see major losses in the S&P 500, a rebound that only took about a year and counting. So very fast compared to historical norms, which brings us to here. Check out this chart here. You are seeing, you really have to zoom in, but gaps lower. We are now 17% of a decline guy when it comes to the S&P 500. Now, these two previous instances of this over 15% drawdown had a rates picture to look at. Dovishness from the Fed in March 2020, hawkishness in 2022. Perhaps that's the policy uncertainty the markets are going to be looking at next.
Absolutely. Let's talk more in detail about policy uncertainty. Are the leaders gathering in Luxembourg today from the EU going to be paying attention to what is happening with these markets? What are the markets signaling about expectations in terms of what the European response is going to be? The mood music certainly at this point appears to be broadly that actually Europe wants to talk rather than deliver a big hit in response. But is that going to change? How will that be altered by maybe what we're seeing in the markets today? Let's go to Luxembourg ahead of that meeting. We've already had a conversation with the Spanish to get their take. Ollie Crook taking part in that conversation. He joins us now. Ollie, set the scene for us. How does Europe respond?
Yeah, Guy, well, the backdrop behind this scene is, as you're saying, basically a bloodbath in the market this morning right across the screen. And what we are anticipating here from trade ministers is against that backdrop, against the kind of selling we've seen over the last couple of days, and really the total uncertainty for the months to come, is what is the European collective approach going to be to the Trump administration in dealing with this? I think we can call it a trade war at this point. There are different views. We've heard from Emmanuel Macron. He's been very explicit. He's been urging European companies not to invest in the United States, to basically put all of those investments on pause, exact opposite of what Donald Trump wants to happen, basically saying that that would be sending a wrong signal. The Germans have also been very outspoken. Remember, the Germans are the second most exposed to the EU in terms of their trade deficit with the United States. Robert Habeck basically likening this tariff increase to the invasion of Ukraine, saying that the Europeans need to be as powerful in their response to that as they were to the tariff situation. We've heard, though, also from the Spanish. We heard just now from the Spanish economy and trade minister taking a slightly more diplomatic approach. That being said, he also said that everything has got to be on the table. Have a listen to what Carlos Cuerpo told us just a few minutes ago.
We have to somehow avoid taking out of the table any instrument. We have the proper tools, the necessary tools to respond. So none of them should be discarded at this point, but we need to keep on sending a message of being open to negotiating with the US, but we need them also to be able to negotiate. We need two to tango.
It's very clear that the Europeans' preferred option would be to have a deal, but listening to Donald Trump over the last few days, listening to Howard Lutnick, listening to Scott Bessent, this does not sound like a Trump administration that is in a hurry to strike a deal. Obviously, part of their goal is to reindustrialize the United States. That will require elevated tariffs for a long period of time. For the Europeans, that is exactly the needle that they need to thread. And as a consequence, they need to put as much sort of pressure there, at least put it on the table. Say, these are the measures we're willing to take in order to have these negotiations with the United States, because despite the fact that they want a deal, they still, as Carlos Cuerpo just told us, need to not be naive about Trump's goals here.
Ollie, great stuff. Fantastic conversation earlier. Thank you very much indeed for bringing it to us. We are watching very carefully what is happening with the defense stocks this morning. It is an area where the market appears to be being forced to sell. You just had Leonardo reopening. I think it might be halted again, but it's, when I got a price a moment ago, down by 16.5%.
33 euros per share, just about 34, and following in suit of the massive moves to the downside we've seen with the likes of Rheinmetall, among many, many others. So, of course, seeing quite a bit of pain in the defense stocks, which have been, at least since the start of the year, a real haven given some of the kind of impulse from a lot of European governments to invest and invest big in that defense infrastructure. Let's bring a little bit more context into this tariff narrative and the geopolitical implications. We're joined now by Elvira Fabry, Senior Research Fellow at the Jacques Delors Institute in Paris. Thank you so much for joining us this morning. Walk us through this impulse here. I mean, we see leaders very quickly struggling to have two very different approaches. Do you match tit for tat the tariffs that Donald Trump has put on your administration, or do you take the opposite approach and do you negotiate? What's the right path forward, Elvira?
I think we should make no mistake. There will be a strong response from the European Union. And the European Commission has been engaging already for long into negotiations. And what we have heard those past days from Donald Trump is that he won't move back. I share completely the analysis that was presented just a minute ago. He just told it. He just said on Friday, those tariffs are there for long. He has promised an El Dorado for the U.S. economy. But that the journey will be painful. So we shouldn't expect him to engage much into negotiation. And let's keep in mind that between the US and the EU, there's only 0.5% of difference between tariffs. So the issue is about non-tariff barriers. And this is not something that we can negotiate easily. So I guess for the moment, between the member states, you have ministers that are adjusting their speech. But we shouldn't make, let's not be confused. The EU is preparing a strong response. It has the ability to do it. It's going to be complex. It has to target notably the kind of services. Yes?
Elvira, what should that response look like? What do you think the package should look like right now?
Well, I think there would be a two-phase response. One that will be targeted on the automotive sector, in addition to what was announced for the aluminium and steel and aluminium. But the big package will be for the 20%, and we see directly that we are in an economic coercion field. So the European Union can use its anti-coercion instruments, which allows it to accumulate many different measures. And the big question is how the EU is going to target some US services, which kinds, financial ones, digital ones. I guess we can expect that the big tech firms, US tech firms, will be directly targeted. It will take a couple of weeks, maybe more, maybe a month. That's not the problem. The issue for the Europeans is really to limit the damage on the EU economy. So we can call it a negotiation phase. We can call it like that. And the Europeans remain open to negotiation. But I'm not expecting Washington to engage much more into that negotiation. And I think we can expect that he will not. He will be satisfied with some concession made by other smaller markets, but the confrontation between the US, China, the EU, and countries like the big markets like South Korea, Japan will continue.
Elvira, you mentioned services, and you mentioned the tech space as well. I would like to zero in on the services here. What kind of services can Europe, in theory, at least on the table, target when it comes to the United States?
You have all the digital services. You could only by implementing the EU regulations, what is called now the DSA or DMA. The Europeans have they can decide how far they can go in the implementation of those regulations. So you could implement some fines on the digital services because they're not complying with those EU regulations, and we know that Meta has been concerned by those regulations. But as well, you could consider that the anti-coercion instruments would allow as well to reduce the access to the EU market to even to some financial services. Maybe the big US banks.
Well, Elvira, you mentioned the digital services specifically, and I'd like to zero in on that, especially the fines when it comes to likes of Meta and Apple. Just for the clarity for our global audience and for myself as well, aren't those fines certainly going through court orders and through kind of the European courts as well to talk about that? How quickly can that mechanism be used if that is even something that's accessible from leaders to the court system?
But first, we would have to distinguish that it wouldn't be a retaliation, right? It's only implementation of EU regulation. It would take time. It's the process of EU legal processes. But there's no urgency in a way. The whole problem is rather to have the unity of the member states. And we would need, for those measures, it's only a legal process. But for the additional measures, if we were to target more through the anti-coercion instruments, those digital services, we only need the qualified majority of the member states. But it's about the main issue for the Europeans is really to get that unity between the member states.
Does the WTO matter anymore? Are we in a world where actually WTO rules no longer apply? Is that a useful tool? Is that a useful forum at this point in time? Do I need to abide by WTO rules?
Yes, it's essential. Of course, the US, through the new administration, has signaled that it wasn't following anymore the WTO rules. And the risk is that the concessions that Washington are asking for with their trade partners would crush the respect of the anti-discrimination principle, the pillar of the WTO. But for the rest of the world, for the 87% that continue to, that imports in the world, while the US only represents 13%, they want to continue to rely on a stable trade system, and they need to defend that system. So it's meaningful also to have countries around the world that complain at the WTO level and that try to abide by respecting the anti-discrimination principle, and avoiding to make some concessions to the US that they wouldn't do to the rest of the world. But of course, we can consider that the system is really at risk at the moment, and that in addition to have a crash in the markets, we could have a really a completely collapse of the trade system.
Elvira, we'll see what happens. We're watching it tick by tick, moment by moment at the moment. Elvira Fabry, Senior Research Fellow at the Jacques Delors Institute, joining us on the trade story. It is certainly being reflected this morning, what we've just been talking about in the markets. Big sell-off across Asia, now being followed here in Europe. Big bid into the bond market. Certainly we're seeing that. The front end of the German curve is down by 19 basis points this morning. Huge bid. Seeking of safety seems to be the trade this morning.
Seeking of safety, but then where do you hide out? In this equity market, I'm looking at 7% declines across Europe.
You don't hide out in the equity market.
You can't hide out in the equity market. You can't even hide on the gold market or even in the dollar. Your traditional safe havens don't exist at all. I want to get a quick sector check here, though, because I think this is important. If we're talking about some sort of China fiscal stimulus or some kind of China impulse that's going to have ripple effects, the miners would, in theory, show it. You are not seeing that this morning. This is a global growth story that's hitting that one. The other one I wanted to keep an eye on was luxury stocks, because it's not just a China story there. It is a broader Asia and supply chain story there, and that's going to feed into some of these stocks, which are also taking a beating. Take a look at this Burberry, down 8.3%.
If your stock portfolio is getting hammered, are you going to buy a new Burberry scarf? I joke, but the relationship is not is not one to ignore, and I think that's going to be interesting. The stock I keep coming back to is Nestle. Nestle should be the place you hide out. Nestle is down by 5.5% this morning. Well, people are selling a lot of stuff they wouldn't normally sell.
Anything that has, I think, given some yield, whether it's Nestle, whether it's some of the luxury stocks as well, because they've been outperforming quite a bit alongside defense stocks, you are selling your most profitable companies this morning. That seems to be the theme across the board. We're going to continue to monitor these markets for you when it comes to stocks, bonds, currencies, and, of course, commodities. Right across the screen, this is Bloomberg.
what would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the opening trade. 51 minutes into today's session and seeing red on the screen across the board. A 6% decline in the DAX, a 6% decline in the Stock 600. And you're continuing to see the pain across the board. Even in the FTSE 100, which isn't selling off as much, still 4.5% declines. If we're looking for some green on the screen, I feel like the FX space is one area we haven't actually talked about because the dollar is continuing to sell off, and that is creating a bid into the euro and the pound. That is not a sentiment indicator. It is purely fund flows. 110 on euro dollar, 129 on cable. But then again, a continuous bid into the Swissy, a continuous bid into the yen. So there is a move for safe havens, Guy. The dollar is just not one of them.
It's amazing, isn't it? So de-dollarization process. That is a big signal on here. Let's talk about what is going on here in a little bit more detail. We've got a fab team around the desk. Valerie Teitel, Michael Masika, who leads our EMEA equity markets and strategy coverage. Let me start with you, Michael. What are you hearing? What is the talk on the chat rooms this morning about what is going on?
Well, Guy, this is very simple. We're talking capital preservation here. This is what's going on. It's like you sell everywhere you made money. So we see it today in Europe with the defense stocks. We've started seeing it last week with the banks. So all those sectors that have been doing very well, people have been long, very, very long those sectors for several months now, sometimes years. They're selling. You sell everything, just you preserve the capital. That's the reaction. That's what we see. Last week, there was a lot of heavy selling from hedge funds, so that's a classic thing. But long-only asset managers have started selling as well. So this is another type of route, I'd say. So like just another level.
Well, hop on in here. I mean, Masika's calling it another level. Is there any positivity on the horizon that say, okay, this sell-off is too far gone, maybe we can buy the dip?
I don't know. I think maybe the one positive is that this is the market is still functioning well. At least we saw that on Friday. The S&P 500 futures, the volumes were surprisingly large. Like the market is really taking this well. And maybe we can tie that to what happened during COVID when the Treasury market completely blew up and wasn't functioning. And that was the first kicker for the Fed to come in and save the day. It doesn't seem like we're headed towards some period of destabilization, at least in the Treasury market or in the equity market for now. But that maybe could be what could prompt maybe some emergency measures from the Fed. But even Scott Bessent was talking on Friday with his interview with Tucker Carlson, saying that the American people should be reassured by the fact that the market functioning and market liquidity is still doing okay.
Okay, let's talk about the American people. How's retail doing?
Well, yeah, that's the cohort that haven't started selling yet. So I was saying hedge funds have been selling for now several weeks. You had long-only asset managers. They've started selling, like especially heavily last week. They might keep selling now just to preserve capital. The cohort that still is very, very, very long and that hasn't started selling is the retail. That's according to Goldman Sachs Prime Brokerage desk. So when they start selling, then we might see another leg down, really, if they decide to. So that's the tricky part. If.
So no one look at your 401ks is what I'm hearing. Over the weekend, we kept hearing this idea that the market is over-levered and that there are already margin calls in place. Are you seeing evidence of that this market is over-levered?
So we don't see evidence of that, but that's what the prime brokerage desks are saying. The leverage was very, very, very high coming into this. So now there's a huge deleveraging happening. Some strategists and traders were trying to assess, okay, where this is going, where are we getting with the S&P 500? If you look at the past episodes of large sell-offs over the past 6-7 years, the S&P 500 started bottoming out between 13 and 15 times forward PE. We're still at 18. So if you assess that and okay, where is the bottom, then maybe that's your target there.
18 from 23 though, right? So that's some, you got to give it credit. That's some progress in terms of a decrease in valuation.
Yes, that's a big in progress. But again, if your global growth is now priced to be zero or even negative, well, then that tells you also where the S&P is going.
Val, what's my North Star this morning? What am I looking at? What's guiding me? Is it credit spreads? Is it what people are selling? Kind of just give me some sense of direction.
To me, this morning, it's developed market credit spreads. I think that's what led the banks to take a step lower, and that's what's leading, this market wobble is really this blowout in high yield. A little bit of wobble. But, I think, Guy, there are still some really big picture questions for the market to tussle over. What exactly does the economic world, does the market look like if the trade deficit of the U.S. is narrowed? And to that, guys, can you actually have an overvalued equity market without this trade deficit? I think that's another question that people are thinking about.
You would have thought theoretically, what happened to the capital? That's the dollar story. Is the dollar the North Star? That I think is an interesting question.
I mean, to me, the dollar is a North Star in terms of the market trying to figure out which economy is going to be hurt worse out of this, right? If the euro is rallying, maybe that's telling us that Europe will be hurt less than the U.S.
Bloomberg's Michael Masika, Valerie Teitel walking us through these markets. Folks, we're seeing red on the screen across the board. It's marginal positivity in the euro, but let's see how long that holds. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Day. Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The global stock sell-off deepens as President Trump indicates that tariffs are here to stay. China discusses front-loading stimulus measures to counter the impact of tariffs as Asian equities tumble across the board. Plus, EU trade ministers seek to narrow their differences as they meet to discuss the response to the tariffs. So there is quite a lot going on. Monday morning, many market moves. Happy Monday, everyone. Now, the carnage in financial markets unleashed by the tariffs of President Donald Trump continuing unabated. Equities getting pummeled, U.S. stock futures. If we look at those showing that last week's $5 trillion wipeout doesn't seem over. Now, S&P futures pointing to a loss of about 5%, 4.4% when Wall Street starts trading. Treasuries rallying. I'm looking at the 10-year yield around 3.9%. So definitely a lot going on when you look at the European markets map. We're also getting a lot of equities being battered. And then if you look at fixed income, Treasuries rallying, definitely pushing the 10-year yield not only to 3.9%, but look, if you look from Shanghai to London, investors bailing on any kind of risky assets. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump and his economic team have dismissed investors' fears of inflation and recession, offering no apologies for the market turmoil sparked by sweeping global tariffs.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world.
Let's bring in Bloomberg's Rosalind Matheson, Lucy Baldwin, Global Head of Research at Citi, and Morris Reed, Partner at Actum. So we have the A-team to try and figure out what happens next. First of all, Rosalind, we'll get to markets in a second. But, I mean, Donald Trump was pretty defiant yesterday, speaking to reporters on Air Force One and in other places. I mean, he seems to have dashed any hope of a quick U-turn, basically saying forget the markets for a second. Is there any way, this is a man-made problem, is there any way that he, unwinds it, or will he double down?
Well, what's the off-ramp? I mean, he has essentially campaigned on this. This is part of his ethos as president. So how do you walk this back or sand it down without looking like you've given too much ground away? And you heard him this morning. He was talking about saying this is part of the medicine of the recalibration that has to go on in his mind for U.S. markets, U.S. economy, and the global economy and the global trading system with it. So he's saying, this needs to wash through. He seems to be, like his officials, dismissing the market moves as something that's just part of the washout from these policies, and sit tight and we'll all be okay. The question is, at what point does he realize he needs to do something? Is he willing to? He is a businessman. He is a negotiator. He does do a deal. But equally, he's bound so much of his agenda as president into this. Like, you can't walk too much of it back without being seen to give too much away.
Yeah, Lucy, you look at this carnage in financial markets, and at some point, it must be that he's getting calls all the time. So there doesn't seem to be an end in sight for this market rout.
No, Francine, you're right. I mean, I think the challenge at the moment is the market is processing the downside risk to economic growth. And so banks like ours are out there busy cutting their forecasts. We kind of expected to see maybe another 3% year for global growth. Most people have taken anything from 1 to 2 percentage points off the US. We're certainly at the nearer 2% end of that range, which is sort of skating dangerously close to recessionary territory. Lots of markets around the world, including obviously Europe, probably faces about a percentage point downgrade from where we were to GDP. And you pull all of that together, you know, you're probably wiping out most, if not more than all, of the 13% earnings growth you saw at the beginning of this year for US markets, and Europe had been expecting 7%. You know, we've come out and said, look, we're looking pretty close to getting zero growth out of these markets from an EPS perspective. Now, if you see the US going back into an earnings recessionary type environment, it's really hard even for markets like Europe, who might be relatively better placed to avoid catching that cold, as we know from old.
Yeah, I mean, Lucy, there's a million questions on actually, you know, there's a chatter of a global recession, but also if you're the Fed right now, I don't know how you deal with it, because I know there's a big pricing into cuts, but they'd probably have to hike and then cut to deal with inflation, then growth.
Well, the Fed has got the hardest job of all the central banks, right? I think the prescription, to your point, is clear in the rest of the world. You can aggressively cut into this because you're having such a bad growth shock and it's a deflationary impulse for everybody else. But for the Fed, to your point, you know, we're expecting to see inflation go from previously expecting 2% to being more like 4% this year for CPI, for PCE. Now, that is a problem for the Fed. Now, our view is still actually that they will focus on the growth problem, right? And so we think they're going to cut. Now, markets are already suggesting 110 basis points of cuts from the Fed this year. We're at 125. So you can see that's why people are pushing into fixed income as an asset class. That sort of, you know, where are the safe havens is another big question. We've just upgraded treasuries, so we've kind of gone long duration. And I think that's the natural response that we're going to see as this continues and people try and find a floor here and look for what is being described as either the Fed put or the Trump put.
And this is what Jay Powell said Friday on this.
I will say, though, you know, it feels like we don't need to be in a hurry. It feels like we have time to, yes, it feels like we don't. No, I mean, it's like I said, you have inflation is going to be moving up and growth is going to be slowing, but it isn't really. To me, it's not clear at this time what the appropriate path for monetary policy will be.
Morris, there's a number of like wild rumors, including, look, Jay Powell was meant to be the fall guy when the markets were going to go down because he hadn't done enough on interest rates. Now, you know, the buck stops firmly with the Trump administration. Do they not care about, you know, the economy and markets?
This is classic Trump. Put the worst deal on the table and negotiate back. I think that we would come to appreciate the Fed chair because he's a steady hand that's really focused on market intelligence and facts. The Trump guys are really doing a gut thing. If you look at all the red on the wall, it tells you that perhaps they've gone the wrong direction. But I expect this to be 18 months full on. I expect him to get more aggressive as the market turns because he's using a gut. This is Donald Trump saying he is smarter than most people. He's not looking at market conditions. He's really saying this is my political gut. And when you have someone like the Fed who's looking purely at facts and information, we will come to appreciate the fact that we actually have checks and balances when a person is running an operation based upon facts, or a person who's running an operation based upon his political gut.
But more so on Friday, everyone was saying, well, where's the opposition? If markets continue doing something bad for longer term, the U.S. economy, people are not speaking up. I mean, people have started to speak up, even people quite close to him. What we heard from Stan Druckenmiller, we heard from Bill Ackman. Who does he listen to if he were to cool off or reverse?
Donald Trump listens to Donald Trump until he figures out a bad guy to take the fall. Right now, they haven't figured out a bad guy. He has a lot of people around him telling him what he wants to hear. Ultimately, this is why I believe this is going to be at least 18 months. There's going to be a lot of pain. It's going to be a lot of suffering. Donald Trump is going to have to look in the mirror and listen to really the type of allies around him that really understand the market, not just people that are politically close to him, but people that are his allies, that are employee people. But ultimately, this is going to come to politics. In 18 months, there's going to be a course correction, if you will. It's going to be a midterm election. That's ultimately, so people need to really get this fundamentally understand this.
Yeah.
This is not going to get better until there's a political opposition with teeth to push back. Right now, there isn't any. So this is going to be 18 months full on until the campaign starts.
I don't know if Lucy can take 18 months of this. I mean, what kind of economy are we left with if this lasts for 18 months?
Well, I think it is radically reshaped relative to what we were all expecting to see, isn't it? And I think, the way we've thought about this is that, you're seeing this massively negative impact to growth, an inflationary impact that's going to last. If these tariffs stay in as we see and the retaliation comes as is now expected, and so, that stagflationary pressure is going to be really significant for the US. And so that's why I think, our view here would be that you probably need to see the shift over to fixed income relative. That's what our asset allocation team is suggesting, hence the upgrade in treasuries. We upgraded bonds more recently. We took an underweight off that we had in Japan. So we can see that that's going to be an important part of what people will need to do to protect portfolios while we see where this floor can be in terms of equity markets. Our view on the S&P is that 4,700 seems to roughly calibrate the tariffs that are on the table. But of course, in addition to that, there's incremental pressure and risk if consumers and if corporates sit on their hands and say, gosh, we can't make any decisions, amidst all the turmoil. So that's the other piece.
But I think this is, to me, this is shocking. Why didn't people believe Donald Trump was going to do this? Why were they not prepared? He was clearly
right, because we thought he cared about the economy and he cared about markets.
Donald Trump cares about his political rhetoric. He started where he left off when he left office. He said the entire campaign he was going to do this. No one believed him. No one prepared. So now the economy, corporations are looking befuddled, and they're like, I can't believe it. But this is exactly what he said he would do. And the fact that corporate America, the political class, did not prepare themselves for this, it's really shame on them.
Rose, do you think countries will retaliate? Because this is something, did Donald Trump think that countries would retaliate, or did he think that they would just bow to his will?
Well, the only one retaliating so far is China, and China is retaliating in a proportional fashion, but quite deliberately. You can see that. And China has the means to retaliate because they've been prepping their economy for a while to be more self-sufficient. They've been diversifying their supply chains, their export markets as well. I mean, what they mostly send to the US is what's going to directly affect, to your point, the consumer. So it's going to have a direct hit there. What they buy from the US, they can probably absorb a little bit along the chain because it's commodities or materials, so it's not like the finished product by and large. So they've got bandwidth, and they're being very strong in that, and it's very clear that Xi Jinping is not going to be talking or expecting to talk to Donald Trump anytime soon. But beyond that, to the point about whether he does change his mind, to use his slang, does he reverse ferret, or does he partially reverse, or sort of reverse ferret? Even if he does change on tariffs, the bigger, deeper issue is the relationships have fundamentally changed, and the relationship between the US and Europe, between US and allies, not just US and foes, but US and allies, long-standing friends in Asia and Europe, in the global south, has fundamentally changed. And that goes well beyond just what happens with tariffs. It goes to the relationships around trade, investment, geopolitics, security, conflict, and more. The US cuts to US aid in Africa and so on. These things all affect US soft power around the world. So you're seeing a much deeper recalibration of these relationships and, dare I say, the global order than just what he does in a minute on tariffs.
But listen, Donald Trump only respects power and money. You see China moving fast because they were prepared and they have power. They're counterpunching. When you don't have leverage with Donald Trump, the best thing to do is cut a deal as quickly as possible so he can declare victory, he can move on, your economy, your business becomes stable. Look at what the law firms did, right? So the only two things he respects, and when you understand this, you understand how to engage with him. So corporate America, why you see people running to him doing deals, they think it's going to ultimately save them. It's not if they don't have real power and leverage with him. He's looking at ticking a box. He's just counting trillions and trillions of deals, not necessarily who he's doing deals with. It's a scorecard for him. It's really about power and money. China is playing it precisely the right way. Europe is moving too slow. They need to get in the game, and they need to start counterport. The problem with Europe is they're not coordinated. That's the real challenge for Europe.
Which he's probably also trying to, if not break up, certainly test.
Yeah, certainly. I mean, you saw Vietnam, for example, they went straight to zero tariffs, and that's had no impact. It'll be interesting to see the Israeli leader, Benjamin Netanyahu, going to the White House today, meeting with Trump, and mostly on tariffs, a little bit of Gaza, but mostly on tariffs. And what does that look like when you get right in front of him and you're someone who's known him for a long time? Do you have leverage there? I mean, to your point about Europe, it'd be very interesting to see the EU trade ministers meeting today, because there is already a range of opinions in Europe. It's mostly about let's sit a little bit and wait. France pushing heavily for a strong response, including to come for US big tech, asymmetrical responses, including The tech sector, France pushing that, Germany pushing a strong response. Other nations in Europe saying, we're a little bit unsure here what to do. And so that question of unity is really important.
So what does that mean for gold, but also longer term? Is the U.S. no longer going to be a reserve currency for the world?
Well, I think that the question mark that a lot of people have right now is on this, concept of the U.S. dollar smile, right? That the dollar does well when times are good, but it's also the safe haven when things are going badly. And is that broken? Is the left-hand side of that dollar smile broken? And reaction since Liberation Day has suggested that there's some real risks to that, right? And I think, that's why, relatively speaking, you might see the euro doing a bit better than the dollar because, relatively speaking, things look a little bit better. And I think the question mark is going to be somewhere like China, where you've got the power of stimulus that you could unleash, and we're expecting to see that happen, and you can mitigate some of the effects. But it then becomes much more of a relative game in a world where you are seeing, in aggregate, quite a big compression to global demand.
Can I just quickly respond? Netanyahu will get nothing. He has no leverage and no power with Donald Trump. He will come there. He will come out with nothing. The best thing he can do is look for his political survival. That's number one to him, his political survival, not the economy. With regard to Europe, they should have the Prime Minister of Italy negotiating on their behalf. Get rid of all these trade things. She has a relationship with him. She should be the point person dealing with him. And this is where they fundamentally still don't get it. He wants to deal with people that he likes and respects and appreciates. Germany's not there. France is not there. If I were them, I would push them forward. But most importantly, if you really want to hit America where it hurts, go after these professional services thing. When you start putting VAT there, that's real pain because that's lots and lots of people. And that's really what America is, a service economy now. We have to wake up to the reality of what the country is and where the economy is moving.
Yeah, and I don't know whether the Italian Prime Minister would actually agree to do that job. It's a good point. Thank you all for joining us. Ross Matheson, of course, our EMEA News Director, Lucy Baldwin, Global Head of Research at Citi, and Norris Reed, Partner at Actum. Coming up, Russia demanding sanctions relief as part of the ceasefire in Ukraine. The European Union is standing firm. We hear from the EU sanctions envoy, David O'Sullivan. That's next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm from Sinacqua here in London. Now, the Spanish economy minister says the European Union needs to be open to all potential means of retaliation against U.S. tariffs. Now, this comes as EU trade ministers meet in Luxembourg today to hash out a unified response to the looming threat. Let's go straight over to Bloomberg's Oliver Crook, who's there. Ollie, what else what's the option actually for a lot of these ministers?
Yeah, well, I think that's the big question, Francine, and really for the trade ministers that are assembled here in Luxembourg, it's for them to really come together and have a unified response for the first time since we got those tariffs declared last week. They will go into force at 20% on April the 9th, and we've had a very different set of opinions from a number of different people. We heard from Emmanuel Macron, as you'll recall, last week, basically telling all European companies to pause their investments in the United States. We had the German economy minister, Robert Habeck, who just walked in just moments ago, saying that basically what Trump has done with tariffs, he likened it to the invasion of Ukraine, and that basically the Europeans need to have as strong a response to that as they did to Russia. We have heard, however, from the Italians a little bit taking a slightly more diplomatic route during this, saying basically everyone should be keeping a level head. We also heard from the Spanish economy minister, whom I spoke to just about an hour and a half ago. Have a listen to what he told me.
We have to somehow avoid taking out of the table any instruments. We have the proper tools, the necessary tools to respond. So none of them should be discarded at this point, but we need to keep on sending a message of being open to negotiating with the US, but we need them also to be able to negotiate. We need two to tango.
So as far as the European Union is concerned, they would prefer to have a negotiated deal. We've known that from the beginning. We've heard that from Ursula von der Leyen. But hearing Donald Trump over the weekend, hearing Scott Bessent, hearing Howard Lutnick, I'm not sure that this is an American administration that is too pressed to come up with the deal at this stage. And of course, with all these different member states, all of them have different interests. Some of them are going to be, yes, very concerned with the issue of trade. Others are going to want to keep the U.S. on side for issues like Russia and Ukraine.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on this trade ministers' conversations in Luxembourg. Now, fresh talks between Russia and the U.S. towards a ceasefire in Ukraine are expected as soon as this week. This from the Kremlin's negotiator. Now, Moscow has been pushing for sanctions relief as part of any deal, but the European Union has indicated it's willing to ratchet up its sanctions on Russia. For more, we're joined by the European Union sanction envoy, David O'Sullivan. Mr. O'Sullivan, thank you for joining us. Now, as we were just saying, Russia demanding sanctions, easing as part of the ceasefire negotiations. The EU has ruled it out and is working on more sanctions. Is there a scenario where the EU would actually consider sanctions easing?
Well, I think, first of all, the most important thing to understand is that after 3 years of the most massive sanctions which we've ever imposed on any country, the Russian economy is hurting. That is why I think Mr. Putin is seeking sanctions relief as part of these discussions. The view of the European Union is that this is a very important point of leverage in any negotiation with Russia, and it should be used, but used very judiciously and slowly, and only in the context of arriving at a solution which is lasting and sustainable peace, as President von der Leyen said a couple of weeks ago. So, yes, I mean, at some point, sanctions relief would become part of the discussion, but we are very nervous about any suggestion that this could happen prematurely or in the context of a purely temporary arrangement.
Has the U.S. reached out to the EU to participate in the negotiations, at least on sanctions?
Well, as you know, this is an issue of some discontent on the European side. I mean, I think many people feel it would have been better to involve more closely the Europeans and indeed the Ukrainians in these negotiations. The U.S. has chosen a different method. We have not yet had any discussions with the Americans, to my knowledge, about the issue of sanctions. And even when Russia did seem to impose, to suggest some conditions of lifting of European sanctions in the context of the Black Sea possible ceasefire, to my knowledge, there was no reach out from the U.S. to ask the Europeans to concede to that. And the European view was that we would not concede to any such a request.
It's our understanding that Europe is not involved in talks so far, but are there any conversations behind the scenes with the U.S.? Have there been any contact?
Our contacts are relatively limited because, to be quite honest with you, many of the people with whom we worked on sanctions in the previous administration have left, as is the normal practice in the US, and many of those positions have not yet been filled. So we are still waiting to have the full set of interlocutors that we have normally on sanctions, and these posts are not yet filled.
Okay, what can you tell us about the 17 sanction package in the works? So what kind of timeline and the size and scope of this package that you're looking at?
Well, I think what's really important, Francine, at this point is that there probably will be a 17 package, or there'll probably be an 18 package, I fear. After the 16 packages, I mean, we have in place the most comprehensive set of sanctions against Russia that we've ever had against any country. We used to trade some 260 billion a year with Russia. We now trade 60 billion. So we've cut our trade by nearly 75%. We have sanctions on 7,500 products. We have sanctions covering most of our financial transactions. We have immobilized 300 billion euro of central bank assets in Europe, and we have frozen some 28 billion assets belonging to oligarchs. So we've already done a lot. We've almost completely eliminated our dependence on Russian coal, on Russian oil, and we are in the process of finally squeezing out the relatively small dependence we still have on liquid natural gas. So, I mean, any new packages will, by definition, be incremental, be adding to this already massive range of sanctions. Clearly, we continue to be concerned about the energy field. There is more work to be done there to finally eliminate any dependence on Russian energy. We're concerned about the shadow fleet and Russia's attempts to evade the oil price cap. And of course, there are always additional sectoral measures that might be considered here or there where we discover loopholes or areas which we'd like to see better covered, such as fertilizers, where we're acting through tariffs rather than through sanctions, but with the same objective.
Mr. Sullivan, can I ask you, I know there's been a lot of turmoil in the last 5 days because of the tariffs announced by the U.S. Does that mean that it's less likely that the EU, if they stay under continued pressure like this for 10, 15, 18 months, will make the relationship with Russia change, that there's less appetite for some of the sanctions put in place because they're reeling from the U.S. tariffs?
No, I think we have put the tariffs in place we have put the sanctions in place because of Russia's unprovoked full-scale invasion of Ukraine and the conduct of an appalling war by Russia on the territory of Ukraine. That we will only lift those sanctions when that situation is relieved or stopped. The sanctions are linked to Russia's aggression in Ukraine. They weren't an economic decision. They were not a decision of economic protectionism or anything else. They were to punish Russia for the unprovoked aggression in Ukraine. And as long as that aggression continues, and as long as there is not a sustainable and convincing peace arrangement, I believe those sanctions will stay and may even be increased.
Thank you so much for joining us. David O'Sullivan there, the EU sanctions envoy. Now, coming up, as the gaming industry also weighs the impact of the global tariffs, we take a look at what the future holds for the sector with Ian Livingston. This is Bloomberg.
in case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European stocks trimmed some of their declines along with U.S. equity futures, but the sell-off is far from over. Well, this comes as President Donald Trump indicates that tariffs are here to stay. China discusses front-loading stimulus measures to counter the impact of tariffs as Asian equities tumble across the board. Plus, EU trade ministers seek to narrow their differences as they meet to discuss the response to the tariffs. So Bloomberg has learned that China's policymakers discussed measures over the weekend to stabilize the economy and markets in the face of Donald Trump's tariffs onslaught. Sources say this includes whether to accelerate plans to unleash stimulus to bolster consumption. Well, Chinese stocks sank this morning as the global round continues. So let's bring in Ellen Wong, who leads Bloomberg's China government and economy coverage, as well as our global trade czar, who hasn't slept a wink in about a week, Brendan Murray. So thank you both for joining us. Alan, how has China responded to Trump's tariffs? They seem to be the only nation really pushing back.
That's correct. China this time hit back quite fast and strong, imposing the same 34% tariff rate on all U.S. products entering the country. And on top of that, it also put 7 more rare earth minerals into its export control list. So those minerals are used in all sorts of high-tech applications, including in the defense sector. So China this time around really showed that we wanted to match the U.S. strength in imposing these tariffs and other trade measures.
Brendan, I was surprised. I mean, the president definitely doubled down, right, yesterday. I mean, you know, I would have thought that with the global market rout that we saw on Friday, and actually I think the markets lost some $5 trillion last week, he would kind of pause. But yesterday he basically said, stop thinking about the markets for 2 hot seconds.
Exactly, and he had his, his top economic officials out, saying the same thing, basically. I think, we heard President Trump many times say that trade wars are good and easy to win, and I think what we're seeing from the financial markets perspective is trade wars are hard and they aren't easy to win. China, as Alan mentioned, hit back at those rare earth minerals. That will really hurt American companies that are, making batteries and high-tech medical devices. That will really leave a mark on the innovative side of the economy, and we'll have to see what Europe does now. Does Europe throw fuel on the fire, or do they let this burn on its own?
Alan, how much more aggressive can China be? And actually, if you look at the Chinese market reaction today, what does it tell us?
Well, the Chinese market reaction tells us that people are panic selling. In terms of China's countermeasures to U.S. measures, I think that's about it for now. But the tariffs haven't kicked in yet, so there's still room for either side to do more or pull back. It's noteworthy that China has already imposed those tariffs on all U.S. imports, and based on the current tariffs already announced, that our economists expect trade between the two countries to basically slow to a halt. So what more can China do in this regard? It remains to be seen. But what we've also seen from China is that they've signaled to the domestic audience that it's digging in. In the front page editorial in the People's Daily, party mouthpiece, China said that don't panic, and we've got your back, basically promising to support the domestic economy by stimulating consumption. It also floated previously mentioned measures such as cutting rates and lowering the reserve requirement for banks to support lending. All those measures, they are more likely now because of the market reaction and also because of potential weakness in the economy because of the hit to China's exports.
Yeah, interesting. And Brendan, I was also having a conversation with Ban Buwej of UBS, and China can't change their business model on a dime. So if they can't export to the U.S., they'll probably export to other countries, and then they will be tariffed more from the U.S. So it's a lose-lose situation.
Yeah, absolutely, and I think you can see President Xi Jinping reaching out to countries in South Asia to try to shore up some of those relationships. Countries like Vietnam, Malaysia, where the U.S. The higher tariffs kick in on Wednesday, and as Alan mentioned, there's a very short window for that to happen. So we'll have to see if another day of a punishing market response turns the attitude in the White House. We heard Elon Musk over the weekend talking about a free trade zone between the U.S. and Europe. So perhaps some of those voices will get louder and louder and somehow stop those tariffs from taking effect. But it doesn't look like it at the moment.
Brendan, I mean, do you have a good understanding? Because I've been glued, all weekend with the equation, and of course there are memes, and it's quite funny that the penguins got tariffs and like tax. But at the end of the day, who does President Trump listen to? Is it just himself because he's held this belief for a long time? Is it Peter Navarro? Is it someone else?
It sounds like the sort of more hawkish wing of the economic team that he's listening to. Howard Lutnick, Scott Bessent. He was also on the airwaves yesterday. Look, at the end of the day, Liberation Day is going to turn into Litigation Day. The courts are really the only thing that look like they have a chance of stopping this. A challenge to the companies will challenge the authority that he's used to impose these tariffs, and that we could see a whole new kind of fight through the courts.
Okay, thank you both for joining us, Alan Wong and Brendan Murray. Now, Bloomberg has also learned that President Trump was close to an agreement with ByteDance over TikTok's ban in the U.S., but the deal stalled over China's objections to the latest tariffs. Now, on Friday, President Trump extended the deadline for the sale of TikTok's U.S. operations for another 75 days. ByteDance says any agreement would need to be approved under Chinese law. Now, the gaming industry is weighing the impact of President Trump's global tariffs. On Friday, Nintendo said it's delaying pre-orders for the new Switch 2 in the U.S. Now, there are fears that tariffs could deal a blow to the sector as video game components are sourced from multiple countries. The industry has had a challenging 2 years with thousands of job losses, studios shutting down, and big games failing to deliver. Well, lots to discuss with Ian Livingstone. He's general partner at Hero Capital and co-founder of Games Workshop and EDOS, the companies behind Tomb Raider and Warhammer. Sir Livingstone, thank you so much for joining us. I mean, you're a legend in the gaming industry. You started decades ago with a lot of success. Did you ever think, first of all, that gaming would get so big so quickly?
Well, we started Games Workshop in January 1975 and had to sleep in a van for 3 months because we couldn't raise any finance at all. All we had was passion and idea and an understanding that people enjoy play, but there weren't enough games around for grown-ups, as it were. But never in our minds did we think it'd become a multi-billion-dollar-a-year industry. I mean, the video games industry itself is worth $250 billion a year. You see Games Workshop, although I'm no longer associated with the company, enter the FTSE 100, worth some £4.5 billion. These are extraordinary numbers, and nobody would have projected that. But the games industry has gone through a cyclical change in the past with hardware platforms coming and going, but this has been deeper than usual, and obviously the impact of tariffs is going to be significant, but only for hardware. So physical goods are going to have tariffs on them, but games are largely seen as a service. They run as a service on digital platforms. Therefore, tariffs shouldn't apply.
Are the two linked, though? If the hardware gets hit, then there's likely to be less innovation in terms of games for the software.
Well, obviously, there's a delay in the Switch too, but there are other platforms and PCs and the other digital consoles and smartphones, etc. So they will continue to flourish, and I think it'll only be a matter of time before the Switch 2.
I know the table version of Warhammer is widely seen as UK manufacturing success story at a time when there's so much pressure on so many companies to bring manufacturing back to our countries, including the UK. What can we learn from Games Workshop?
You have to find your audience. I mean, the Games Workshop experience really hasn't changed in those 50 years. It's making games for like-minded people. When we started off, when we opened our first stores, we didn't hire traditional retailers from high street stores. We employed people like us. So they might have looked like Visigoths, but they're hugely specialists in their knowledge, and that knowledge of products, how to paint figures, how to explain the rules, made people feel very comfortable, and they ended up spending a lot of money inside the shops because they were talking with friends. So their experience, I think, you have to really understand your audience, and in video games in particular, you have to build a community around them. So if you're seeing more and more developers working through Discord and other community-based software platforms to engage with an audience, to get buy-in and support and love for the products that they're creating.
I mean, when you look at lucrative markets or lucrative lines of business, I know, for example, for Warhammer, there's quite a lot with Space Marine 2 and a planned show on Amazon. Does gaming and kind of streaming or even shows on platforms such as Amazon the next frontier?
Well, everyone's talking about transmedia in games, and there's obviously been a connection with the silver screen. I mean, there's been lots of games licensed over time. I mean, we licensed Tomb Raider way back, some 20-odd years ago, to Paramount, and it was a great success. And we've seen recently with HBO doing a fantastic job of translating a video game, The Last of Us, onto TV series that really respected the audience. So I think it's understanding the audience, that the games industry and the games audiences are, they're very passionate about their hobby and passionate about the games they play. So you have to respect that IP.
What do you think is the current state of the video gaming industry?
It's going through a transition, but the economic headwinds will pass, and it will continue to grow. I mean, games help define us of who we are as human beings, and Generation Z, Generation Alpha, prolific use of social media, everything they do is interactive, they share everything, and obviously games speak to that way of behavior. So they want to have agency, they want to have control, they want to meet and play and be with friends online in gaming environments.
I mean, Eidos, I know, is one of the best-known video game publishers right in its time.
Yeah.
Why has the UK not been able to replicate such a success story?
Well, we had incredible intellectual property, and it's kind of, for me, a little bit disappointing and almost sad that games like Tomb Raider, Grand Theft Auto, Football Manager, Golf Clash, Fall Guys, and many others, global success stories, are now foreign-owned. I think it's not our ability not to be able to scale and have enough capital available to be able to give the IP creators a further ownership of the value chain without having to sell out too soon. So that access to capital, I think, is paramount, because the government might say, oh, well, it's great because you get inward investment and job security, but if the taxable income is being taxed overseas, we become a work-for-hire nation, which can't be good in the long term.
So how do you fix that?
Well, get the makers and the money to understand each other's worlds a little bit better. You see huge amounts of capital coming from the United States, from China, from Japan into the games industry, and they own all our blockbusters now. Yeah. So we must have greater faith and an understanding that games are here to stay. It's an incredible market, and let's play.
We spent a long time figuring out what AI means for this industry and that industry. What does it mean for gaming?
I think it should be seen in the short term definitely as a tool. It should be seen as positive, but it can never replace human creativity, to my mind. That unique creativity that we have as human beings is irreplaceable. All it can do is aggregate historic content that's already out there. So it should be seen for procedurally generated content, maybe self-generating games at some point. as long as it doesn't replace the human condition of creativity in games, we should all benefit.
Is there a danger that it could actually, or that it brings new entrants really on the cheap, so that the industry...
Well, if games become self-generating through AI, then obviously that's going to have an impact on jobs. But if it's seen as a tool and respect intellectual property, I'm sure the lawyers are going to have fun in the future with AI. I hope it can be used in a very positive way.
Sir Ian Livingstone, thanks so much for joining us.
My pleasure.
We need to make this a regular, Jude.
I'd love
I know
to.
There's a lot of gamers
I could talk about games all
watching
day.
us. General partner at Hero Capital and co-founder of Games Workshop and EDOS. Now, in the meantime, we go back to tariffs, and Nouriel Roubini has warned that if President Trump does not dial back on tariffs, the U.S. will face a recession. Now, the chief executive of Roubini Macro Associates has told Bloomberg that if Trump does not de-escalate, there'll be a full-blown trade war with China.
Well, it's a game of chicken between Trump on one side, Powell at the Fed on the other, and Xi Jinping on who's going to be blinking first. You know, Trump is trying to nudge Powell to blink and his monetary policy as a way to push markets higher. But Powell knows that given what happened on April 2nd, if he blinks, there'll be a de-anchoring of inflation expectation, and those stars are going to lead to higher inflation. So he's not going to blink. Of course, there is a Powell put, there is a Trump put. But Powell, I don't think he cares as much about the stock market. He cares about high yields. Because if high yield spreads were to widen a lot, that's a true sign we're going to go into a recession. This past week, high yield spreads have gone up only 100 basis points. That's not yet a distressed point of view. The point about the Trump put that he doesn't care anymore about the stock market, and he believes that actually long rates have gone lower, the dollar is even a bit lower, maybe that's an easing of financial condition, so he doesn't want to blink. And when it comes to Xi Jinping, there's the beginning of this game of chicken between Trump and Xi Jinping. We started with attacking them, they retaliated, we may retaliate, they're going to retaliate. That's going to lead to a full-scale trade war. I think that Xi Jinping has more leverage. He doesn't face an election next year. He can use monetary policy, fiscal policy, and currency policy, and structural policy to strengthen domestic demand. And he's not going to give a Xi put a signal is going to start to negotiate until Trump is really serious about de-escalating. But it looks like Trump doesn't want to de-escalate with China because he wants to corner China and to lead to a radical reduction of the trade imbalance between U.S. and China. Now, in this game of chicken, I think that we end up actually that the rational thing to do for Trump will be to de-escalate, because if he doesn't, there is for sure a recession. If there is a recession, he loses the midterms, and then he's politically gone.
Well, that's Roubini Macro Associates Chief Executive Nouriel Roubini speaking to Bloomberg. Coming up, traders price in 5 Fed cuts as U.S. recession fears mount. More on the market fallout from President Trump's tariffs. Coming up, this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg has has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, stock markets are tumbling this morning as traders rush to havens. Let's assess the overall reaction to U.S. tariffs. Bloomberg's MLive strategist, Sven Ram, joins us from Dubai. With me here in the studio, Bloomberg's Charlie Wells and our global autos editor, Craig Trudeau. We have team coverage. So, Sven, markets pricing in 5 rate cuts from the Fed this year. Is the market just overdoing the dovish bets?
It's hard to say that, Francine, because I think that the markets have all characteristically been overpricing what the Fed, how much the Fed will cut. But I think in this one instance, I think they are not wrong to bake in the kind of rate cuts they are doing. Why do I say that? Because the economy is going to go into a tailspin because of what Trump has meant on tariffs. And I think that the longer the tariffs continue, the worse it will be the real outcomes will be for the economy. And I think that it means that a shrinkage of trade and corporate earnings and all that. So if you assume a 30 to 40% decline in earnings rate, that's severe. That puts us back in a depression kind of era. And nobody wants that, but that's what will happen if Trump persists with tariffs. And in that scenario, the Fed will come out and cut rates. Back in 2020, during the pandemic, the Fed came out in March to cut rates first by 50 basis points and then by 100 basis points, 150 basis points, both in emergency settings. And that is what the markets are fearing. And therefore, the markets are not wrong to factor in the rate cuts that they are factoring. If the tariffs persist, this is what will happen.
Yeah, and of course, many also betting on an emergency reduction. Charlie, you're looking at the financials for us and actually have 2 big billionaires. One, Bill Ackman, who's also a real backer of Donald Trump, suddenly saying, like, look, this is not a great idea. I don't know whether that's enough to do for the president to do a U-turn.
I mean, Francine, the question had been, when would these billionaires start kind of showing dissent? And that certainly has started. And I think with Bill Ackman, he talked about how this was a mistake in a post on social media over the weekend. He called about how the president needs a 90-day pause here to let cooler heads prevail. And I think some of his words here are really fighting. He talked about how, quote, the president has an opportunity on Monday to call a timeout and have the time to execute on fixing an unfair tariff system. Alternatively, we are headed for a self-inflicted economic nuclear winter. So those are some of the strongest words that we've heard so far, and they're notable coming from a backer.
And Craig, so you're looking, of course, at the autos industry. How chaotic has their response been to these tariffs?
It's really been all over the place. So we've seen Ford and Stellantis come out with these really aggressive deals. I think that may be an indication of their having quite a bit of inventory on their lots, more so than a signal that they're going to be able to sort of rise above all this, and a sort of an attempt on their part to keep the consumer sort of at ease and reassure them in these turbulent times. On the other hand, you have Hyundai, saying we're going to keep prices steady for a certain amount of time. You have Volkswagen taking the sort of 180-degree different, move here and saying they're going to actually put import fees on the sticker of their vehicle. So it's really all over the place what we're seeing manufacturers doing.
And then, Craig, Jaguar Land Rover also pausing exports to the U.S. This feels significant.
This is a huge deal for the UK auto industry, which is already in sort of a world of hurt of late. JLR is sort of neck and neck with Nissan as the biggest manufacturer in the UK. For them to sort of lose access to what is their biggest market in the world in North America, the U.S. being the biggest part of that, is massive for them, and there's a real question of how long can they, sort of allow for the fact that that's just been wiped off the table.
Yeah, Yvonne, so we're looking at real businesses kind of having to deal with it. What's your expectations for Treasury yields? Where do they go from here?
Well, I think that to the extent that the markets are going to price in further rate cuts, I think that Treasury yields will fall from here. I think that the 2-year yield has potential to fall all the way back to 3%. That's assuming 6 rate cuts from the Fed is possible if you assume the worst of the Trump tariffs fallout. And that will mean a 10-year yield of 350. But those are kind of the extreme tail of the scenarios we're talking about. That's not the kind of central scenario. But the central scenario assumes that the Fed is going to, the White House is going to roll back some of the measures, or at least put on hold some of the measures for the time being.
Yvonne, stocks are also really, really slammed. So what would it take to stop that slide?
Well, it's going to take a lot. I mean, they are going to have to revoke and walk back some of the measures or put them on hold, as we just discussed. Because if you look at the earnings yield, aggregate earnings on the S&P, Francine, it was about $240 at the end of 2024. If you assume that this is going to crimp corporate earnings by 30 to 40%, we are talking about an EPS of about $150, and if you use the median PE on the S&P, which is about 17.8, you will arrive at a fair value of about 2,500 on the S&P. We are at 5,000 plus, so that means that we are only halfway there, which means that the declines have further to go.
Yeah, Yvonne, I mean, this is impacting kind of like all walks of the market, including Charlie M&A. How many deals have been taken off the table?
Francine, it's billions of dollars of deals, and this was a disappointing year, and it's becoming even more so. So on the IPO front, we're seeing some of the most hotly anticipated IPOs put on pause. I'm talking about Klarna. I'm talking about StubHub. I'm talking about eToro. eToro's roadshow was scheduled for this week, and that's been put on pause. On the M&A front, you've got a number of big names to the tune of billions of euros here in Europe. Saint-Gobain, the French building materials company, they have paused a sale of their auto glass maker, and that could have fetched as much as 2.5 billion euros. You've got Gerresheimer, the German packaging goods company. KKR walked away from a consortium that was considering a takeover. Again, 2.5 billion euros that could have been, that was the market value there.
And Craig, I mean, a lot of companies or a lot of banks are revising down their earnings per share forecast and trying to remodel this. Unclear how they do it, given we don't know where tariffs end up. But I think car makers have it the worst because they were already struggling before any of this announcement.
Yeah, I think you had a lot of manufacturers that were really having challenges with the electric vehicle transition. All of the investment they were putting into that, only for the momentum toward EVs really slowing dramatically. And so here in Europe, you have companies now that rely on the U.S. for a substantial portion of their earnings, and we're talking about if this level of tariff stays in place, huge blow in the side of their operations in the months to come.
Okay, thank you all for joining us. We have full team coverage. Venram, of course, Charlie Wells, and Craig Trudell. Traders, once again, boosting actually their expectations for the Fed interest rate cuts this year, as a lot of these tariffs really ignite fear on the markets, and we're clearly seeing a very big risk-off mood. Actually, markets increasingly betting on a possible emergency reduction as well. Now, the Democratic Senator Elizabeth Warren is on balance of power later today. Catch that conversation at 9:30 p.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Tariff turmoil. Futures plunge alongside global stocks from Shanghai to London. Traders price in 5 rate cuts over the next 12 months. Take the medicine. President Trump brushes off fears of market routes. Treasury Secretary Bessent sees no reason to price in a recession. Meanwhile, Morgan Stanley sees U.S. stocks dropping as much as 8% further. Goldman Sachs, for its part, boosts its recession probability. There's panic on Thursday and Friday. I think it is fair to say another day of panic today. How do you price in a complete reordering of American and global trade? This is the market's attempt, with another more than 3.5% decline for your S&P, nearly 4% for NASDAQ 100, and a plunge of 4.5% for your Russell 2000 futures. Look at the VIX on the screen below. 53% is where we stand, the highest in some time. Now, it is after the biggest 2-day sell-off since COVID. If we open up to these levels and end these levels, we will indeed be in a bear market for the S&P 500. Treasury yields, meanwhile, those are plunging off the lows of this morning. At one point, your 2-year yield was down 22 basis points. It is still down a lot, reflecting also moves in Europe. We are down 12 basis points. And for your 10-year yield, we're down 4. Most of the curve moving below 3%, the long end still above 4. We are pricing in a full 5 rate cuts over the next 12 months. A quick check on FX this morning, because we are getting a haven bid when it comes to the yen. The yen stronger versus the dollar. It has been a lot of dollar weakness, though. Look, the euro is stronger versus the dollar. The Bloomberg Dollar Index just barely hanging in there. Are we not yet on the other side of the dollar smile, or has something changed and the dollar isn't getting as big of a bid as it is risk off? But it is risk off this morning. Overall indexes are down. Let's look at some of the individual stocks feeling the pain this morning. Here with us with that is Bloomberg's Joe Easton. Joe, good morning.
Morning, Danny. So I've got my eye on Howmet Aerospace in the pre-market, dropping around 9%. There was a report over the weekend saying the company could potentially declare a force majeure on its products if it's hit by the tariff uncertainty. And we've seen a feed through into the European peers as well this morning. It moves lower across that sector today. Then I'm also looking at Tesla, the long-time bull on the stock, Dan Ives, over at Wedbush, slashing his price target today, saying the company's brand image over in China China is potentially going to be hit from the tariff effects, and therefore some of their competitors in China could do better. Tesla continuing its losses today. And then over in banking, Goldman Sachs downgraded at Morgan Stanley today. The analysts over at MS reckon the company's investment banking business is surely going to be hit by the volatility that we are seeing in the market at the moment. So they cut the rating on that one. Then finally, just going to give a quick shout out for our pre-market opening bell wrap that will be available on the terminal soon from the stocks team to run you through all these moves and more before the opening bell in New York today.
Joe, it is a volatile day that's so important. I would endorse that sign off to go look at that blog. Joe, thank you so much. Bloomberg's Joe Easton. Just a few minutes in the hour, we're going to be speaking to Ian Steely of JP Morgan Asset Management. Later in the hour, Alistair Pinder of HSBC joins us. Two conversations you don't want to miss. But back to our top story, the story of the day. President Trump has told reporters on Air Force One he wasn't intentionally fueling a market sell-off. But he was clear the administration is having no second thoughts. His goal, reduce trade deficits.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. But sometimes you have to take medicine to fix something.
Joining us for the latest on the tariff fallout, Brendan Murray, who leads Bloomberg's coverage of trade, Chief European Correspondent Oliver Crook, and Bloomberg's China Economy and Government Editor Alan Wong. Brendan, I want to start from you. We have heard Navarro, we have heard Bessent, we've heard various people, Trump himself, get out onto the media, talk about what they are doing. It doesn't seem like there's any signs of backing off.
No, not at all. The president and his top economic advisors spoke at length on the Sunday talk shows, and they're sounding as unapologetic as they ever have about the impact that these tariffs are having. We had the 10% universal tariff take effect over the weekend, and we have the much higher reciprocal tariffs taking effect in less than 48 hours. So there's a window here to perhaps the president could soften some of those tariffs, but it doesn't sound like it's going to happen. And obviously the markets are trying to factor in the economic impact of that, the headwinds that will come with slower growth and higher inflation.
It's a hard thing to price in because we are just in the world of economic theory at this moment, Brendan, but Vietnam may be an interesting case study in this. Peter Navarro spoke to Fox yesterday, speaking to the negotiations that have been going on with the country. Just take a listen to what he said.
If you simply lowered our tariffs and they lowered our tariffs to zero, we'd still run about a $120 billion trade deficit with Vietnam. And the problem is all of the non-tariff cheating that they do.
And Brendan, this also speaks to the very formula that they use to craft these reciprocal tariffs. It's about bringing trade deficits down to zero. So is there really any scope for these countries to negotiate?
Not in the short run. The long-term goal is to reduce those trade deficits that the U.S. has with its bigger trading partners like Vietnam, China, Europe, and Canada and Mexico. But those aren't going to be fixed overnight. And what the administration is talking about is, a complete overhaul of the industrial base of the country. They would argue that these tariffs will form a protective wall around manufacturing, and that jobs will be created, investment will flow in. So it's that's their longer-term goal. But the problem now is surviving the short-term shocks to the system that we're seeing transmitted through financial markets. And ultimately, the American consumers are going to start feeling the pain, and we'll see if that translates into pressure on Republicans to convince President Trump to scale these back in some way. But in the meantime, they're going to have to ride this storm out.
And it's pressure throughout the world. The Nikkei also on course for a bear market. China's stocks down sharply after reopening from a Friday holiday. Alan, I want to bring you into the conversation on that. It is painful globally. The Chinese unveiling reciprocal tariffs on Friday. What has been the response so far?
Well, today the Chinese market had some of its worst days since the Asian financial crisis back in 1997-98. So the market response is loud and clear that they don't think China and the U.S. could strike a deal anytime soon. And what's also very important is that earlier today, China's official newspaper, People's Daily, published a front-page editorial basically calling the Chinese people to dig in. That editorial says that China should no longer harbor the illusion of striking a deal anytime soon. And it also vowed that China will support the domestic economy by stimulating domestic consumption and also hinting that China could cut rates and the reserve requirement for banks to support lending in the coming days and weeks. The timing was uncertain, but China is now signaling that its domestic economy is ready to take whatever the Trump administration might give it.
At the same time, I mean, we're so different from where we were at the inauguration when China sent one of their top envoys to witness Trump being sworn in as president. Alan, just how frayed are the lines of communication now?
Well, China's leader and Trump haven't spoken since Trump returned to the White House. Later in April, we know that China's officials, not President Xi Jinping himself, will travel to D.C. for some meetings at the IMF. So there might be a chance for some officials to cross paths and maybe they can talk things out a little bit. But we don't expect any high-level exchanges anytime soon, just because both sides seemed to be, at disagreement about what concessions they could offer one another.
Right. Well, that's Asia. Europe also under the pain today. European stock 600 down nearly 6%. Oliver, what are we expecting from the Europeans? Might we get reciprocal tariffs, retaliatory tariffs rather, from them at this moment as we look at European markets also melting down?
Yeah, Danny, probably not in the immediate term, but what the European sort of leaders and policymakers need to do here is to come up with a coherent and a critically unified solution. We have the Italian foreign minister who's right behind me now speaking to journalists, and there are a number of people who have streamed in over the last sort of few minutes, and I'll just give you an example of where the divisions sort of lie. We had at the same time Robert Habeck, the German economy minister, and we also had Simon Harris of Ireland, who deals with all of their trade issues. These are the two countries that run the biggest trade deficit with the United States. Robert Habeck from Germany is saying that basically you need to start putting everything on the table. This anti-coercion instrument, this is a new law within the European Union that's been around only for a few years, has never been used, and is really seen as the extreme option. He says you need to put this on the table. He has likened Trump's tariffs to the invasion of Ukraine and that the response needs to be commensurate, while at the same time you hear from the Irish saying that basically the #1 goal needs to be not escalating the situation and that using that instrument would be the nuclear option. These are the kinds of conversations that are going to be coming up right now in the next few minutes behind these closed doors in order to try to get a conversation about how to bring Donald Trump to the table. But listen, Danny, as you just sort of highlighted, listening to the Treasury Secretary, listening to the Commerce Secretary, listening to Donald Trump, this does not necessarily sound like an administration that is in any hurry to come to a deal. That is, of course, what the European Union would like. This is a $1 trillion trading relationship. It is not clear that they're going to be able to get that, so they need to put all of the options on the table and have a menu available for the worst-case scenario.
And even if they could negotiate, who's to say that they could get it done in 48 hours' time when those reciprocal tariffs go on? Brendan, Oliver, Alan, thank you so much for joining this morning for your team coverage on global reactions to tariffs. Let's get you some other top stories that are trending on the terminal this morning. President Trump says that China's objections to new U.S. tariffs have stalled a deal to sell off TikTok to keep it operating in the U.S. Before he announced widespread tariffs, a deal was reportedly close. Trump previously has said he would be willing to cut a deal with China to lower tariffs if the country agreed to a TikTok sale. As Japan's Nikkei enters a bear market for the first time since August, Prime Minister Ishiba told Parliament that he would strongly urge President Trump to drop the planned U.S. tariffs on Japanese imports. Sources say Ishiba is trying to hold a phone call with the president as early as tonight. Bill Ackman and Stan Druckenmiller have slammed President Trump's decision to launch expansive global tariffs. Ackman says the new trade regime is a mistake. Druckenmiller expanded on criticisms he made of the policies from an interview in January. Bloomberg News couldn't independently verify Druckenmiller's account. Coming up, yields drop, carnage continues in global stock markets. Ian Steely of JP Morgan Asset Management joins us next on your Bloomberg Brief.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's your Bloomberg brief on this Monday morning. I'm Danny Berger in New York. A quick check on your bond market. Yields falling globally here in the U.S. We're down nearly 14 basis points on the front end. At what point that was 22 basis points lower. So we've come off the biggest gains of treasuries, but still trading at the lowest level since September of 2022. Your 2s and 10s now below 4%. Pleased to say that joining us now is Ian Steely, Fixed Income International CIO at JP Morgan Asset Management. Ian, first of all, thank you for taking time off of your desk. I know that it is probably hard to find in this environment, but look, it is a market in panic, but it is a difficult task. We are in the land of economic theory. What does it look like to live in a world where the U.S. tries to take the trade deficit to zero? How do you even begin to think about pricing that in and what the world looks like at that point?
I think you've got to consider what was expected versus now what's happened. And the reality is it was significantly more aggressive than the market expected. We've seen that come through. We've seen this huge shift in sentiment, particularly in risk markets. The Treasury market is obviously a big beneficiary of that, as you've just mentioned. And the reality is until something changes, until we get either a pullback to some extent from the administration, or, as you earlier mentioned, from kind of what Jerome Powell has to say and what the Federal Reserve has to say, the reality is the market's going to continue to be very unsure, very uncertain about what's going on. And I think we're going to continue to see an amount of pain in the market, and that, again, is going to be supportive for fixed income.
Well, Ian, you've said that the risk of a recession is 50%, but we're not pricing in 50%. What does it look like to price in even odds of a recession?
I think what you've got to say is we now have a significant amount of cuts being priced in from the Federal Reserve. Now, will they be able to go through with that? Again, we saw Jerome Powell and what he said on Friday, but I think the reality is if you continue to see weakness in financial markets, if you continue to see a tightening in financial conditions, that's very important. And ultimately, it feeds into the hard data. Then the reality is they will have to move. They will have to be in line with what the market is expecting or pricing, and possibly even further. And then the question will be around risk markets. We've seen a big correction into bear territory within the equity space. Credit spreads have widened, but we could still see some weakness if we continue to get uncertainty around policy and how it's going to be going forward.
Ian, I actually want to take a listen to what Powell said on Friday. Here's what he said as markets were in the midst of a meltdown.
Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem.
Again, Ian, the market was melting down and Powell was talking about keeping inflation expectations anchored. Is this now a reactionary Fed that will not be cutting until it sees the whites of a recession's eyes?
Yeah, I mean, I think he is in a difficult position. There is a bit of a pickle going on because ultimately they are going to have inflation higher than they'd expected, a lot higher than their target. But I still think they will focus on the jobs market. I still think they will focus on the economy. And if you do start to see weakness in it, then I think that's what they will be reacting to. I think they will step aside and they will say this is a one-time price shock. But the reality is, if you are going to see people losing their jobs, if you're going to see GDP going into negative territory, they're going to have to react, and they're going to react aggressively. And we know that they do that when we look at what their response has been during past recessions.
But given the response of what usually happens in past recessions, Ian, you usually get in addition to deficits, maybe another 5%. We're already running something like a 6 to 7% deficit. So you're talking about huge debt levels. If we do enter something that looks like a recession, does that cap how attractive treasuries are in this environment if we're going to a cost push type of recession and inflationary environment?
I think what that argues for is that you'll be looking at a steeper yield curve. What you'll be thinking about is that the front end of the yield curve, as we're seeing today, that will be reacting to what the Federal Reserve is going to do. That will be reacting to the Fed cutting rates more aggressively. But as you are completely correct, the long end of the market, that might not be as supported. It might not be as attractive, particularly to overseas investors. So I would be very supportive of the yield curve steepening, and I think that's what we're seeing today. I think that continues.
I want to stay on that point of overseas investors because the dollar hasn't been strengthening as much as you might expect. Yes, slightly stronger today. It is weaker versus the euro, slightly stronger on Friday. It was weaker on Thursday. Does this represent a type of paradigm shift where you don't get that dollar smile that we're used to? And does that mean that global flows that usually came into U.S. markets, that usually came into bonds, that they cease to go on because you don't have that hedging property of a stronger dollar when you have risk off?
Now, I think that's a really good point, and actually our currency team have been looking at it as what they're now terming the dollar smirk. So we're not seeing as aggressive dollar support when we're seeing falling in risk assets. And that's partly because we've seen so much money flow over into the dollar, into the US over the last few years. As that comes out, as some of the question marks around what's going on in the US, as that demand for US equities, for US assets does start to fade, people are going to be looking, investors will be looking at other areas around the world, looking at some of the valuation of the dollar, which still looks pretty overvalued compared to long-run averages, that maybe we're not going to see that level of support for the dollar during these times of stress. And people will be looking at other parts of the market. And as you said, we've seen the euro, we're seeing the yen, we're seeing the Swiss franc, other safe haven markets. Perhaps that's where capital will flow to when there is these levels of concerns.
Ian, some huge changes to grapple with, more than we have time to do this morning. Ian, thank you so much for joining us. Ian Steely of JP Morgan Asset Management. A quick check on markets as we head to the break. As Ian mentioned, we are getting a bid to bonds. The longer end not doing as well as the front end, though. We're lower by about 7 basis points on your 10-year yield. The S&P 500 futures fall another 4%. If it opens up this way, we will be in a bear market. Coming up, we're going to look at headlines from around the world as we grapple with tariffs and try to analyze them. You are watching Bloomberg Brief.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back. And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's look at the front pages this morning, and it is all about tariffs. Everybody leading with this. The New York Times is leading with the market story saying expect more declines in markets when trading starts in the U.S. in a few hours' time. In oil markets, prices have fallen about 4%, adding to steep losses last week. They also note that CEOs have begun to warn consumers that they should expect prices to increase on some groceries, clothes, and other products. Here's how the Wall Street Journal leads with tariffs. They say that as markets swoon, countries flock to negotiate. Trump spent much of the weekend out of sight in Mar-a-Lago. He did post on Truth Social Saturday saying, hang tough, it won't be easy, but the end results will be historic. He has posted on Truth Social more than 40 times since the tariff announcement, but he hasn't given formal remarks aimed at calming the markets and instead has basically said he didn't engineer the market sell-off, and you got to stick with it. Now, the Washington Post, here's how they lead on tariffs. That the Trump administration officials blitzed television network Sunday to defend the president's massive tariffs. Treasury Secretary Scott Bessent dismissed predictions about a recession on NBC's Meet the Press. Meanwhile, White House senior counsel Peter Navarro said on Fox News not to panic. To be clear, the overriding message from all Team Trump has been reciprocal tariffs are coming on April 9th. And here is the markets trying to cope with that. You're looking at commodities selling off. Copper has been so volatile. At one point, it was down 7%. Then it pushed positively. It's down nearly 1% again. NYMEX crude down 4.3%. And global equities selling off. Coming up, we talk stocks. More losses piling up on Wall Street.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Tariff turmoil, futures plunge alongside global stocks from Shanghai to London. Traders price in 5 rate cuts over the next 12 months. Take the medicine. President Trump brushes off fears of market routes. Treasury Secretary Scott Bessent sees no reason to price in a recession. Meanwhile, Morgan Stanley sees U.S. stocks dropping as much as 8% further. Goldman Sachs boosts its recession probability. Panic on Thursday, panic on Friday. Welcome to Monday. Another day of panic, another day of selling. Your S&P 500 future session off by nearly 4%. It is over 4% for your NASDAQ 100 and Russell 2000 futures. If we open up at these levels, we will indeed be in a bear market for the S&P. We are already there for the NASDAQ 100. But how do you price in a complete reordering of American and global trade? This is the market trying to figure that out, or at least selling stocks and buying bonds. Your 2-year yield down 11 basis points. We're pricing in 5 rate cuts over the next 12 months. Your 10-year yield, that is at 3.9%. But as we were just talking about with Ian Steely of JP Morgan Asset Management, the long end will underperform because of ballooning deficits in a recession, if indeed that is the way we are going. A quick look at FX. It is Haven buying the yen, outperforming this morning. The dollar weaker versus the euro. The dollar having a hard time holding on to gains. Are we now in a dollar smirk instead of a dollar smile? Well, to our top story, the only cure is tariffs. That's what President Trump had posted on Truth Social last night. The White House wants to reduce financial deficits with foreign trading partners. And for now, a market sell-off doesn't seem to be swaying the president or his closest advisors.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. But sometimes you have to take medicine to fix something.
Joining us for the latest is Bloomberg's Brendan Murray, who leads our coverage of global trade. Brendan, the question this market is asking this morning, is this about reducing tariff barriers and making global trade more free, or is this about taking the trade deficit to zero? Which does it seem like at this point?
Yeah, it seems like the latter at this point. The only real dovish comment over the weekend we got about trade was from Elon Musk talking about how the U.S. and Europe should be a free trade zone. Everyone else, including the president himself, dug in their heels and weren't apologizing for the fact that the market is selling off in the way it is, and that they are pushing ahead with this fundamental change in the U.S.'s trading relationship with the rest of the world. That's going to cause a lot of short-term dislocations for the dividends that they think can pay off down the road. More jobs in manufacturing, investment flowing in, and the U.S. becoming an industrial powerhouse again to rival China. So I think the markets seem to be reflecting is that this is not going to be an easy, good thing for the economy. The president has said trade wars are good and easy to win, and I think we're finding out the opposite is true.
We've also learned that the phone apparently has been ringing off the hook of those trying to negotiate with the Trump administration. Brendan, what do we know about any negotiations and whether any of it looks like it might be sticking or working?
Yeah, look, so those phone calls can take place over the next few days, but that's not going to get around the fact that 10% tariff on every trading partner has already taken place, and much higher levels. China's 34%, Vietnam's 46%, Japan and Korea at the mid 20%, and Europe at 20%. Those are kicking in less than 48 hours, and it's going to take a lot of deal making expertise to get any sort of relief from those taking effect. Given the attitude of the Trump administration, which is let's let these take effect, and then we'll start negotiations from there.
Yeah, and Scott Besson, speaking to Tucker Carlson, said I wouldn't even be watching country negotiations. I'd be watching company negotiations, really seeming to signal that they don't even care about the countries. They just want to see companies move into the U.S. Brendan, thank you so much for your coverage this morning and every morning. Bloomberg's Brendan Murray. Well, in reaction to the tariffs, Wall Street has been cutting year-end S&P 500 targets left and right. The latest comes from Oppenheimer at 5,950. Goldman's David Kostin saying that the U.S. stock market is yet to price in a recession, writing, quote, the 2022 experience shows that the markets can continue to decline in the face of deteriorating fundamentals, even alongside light positioning. Morgan Stanley's Mike Wilson also says that he sees stocks dropping another 7 to 8%. Let's add another expert voice to the conversation. Joining us now is Alistair Pinder, global equity strategist at HSBC. Alistair, thank you so much for joining on what's another chaotic morning. Yeah. Look, it is so difficult to figure out. This is the stuff of economic theory put into practice. So when you look at an equity market again this morning, down violently, how much more painful could it get?
I think in the near term, it can definitely get more painful. I think, the positioning is definitely signaling to us buy signals. But the thing is, if you take the COVID-19 as an example, what caused the market to bounce was the Fed put and the government coming in. And at this point, I don't think you see any of these things supporting the market in the near term. So I think we're basically in capitulation, and I don't think we have any near-term support for the market. And of course, we have the US earnings seasons coming up. I think that's going to be a complete mess. I think, companies that beat on earnings are just going to be ignored. Companies that miss is going to basically reinforce this US recession narrative. So at the near term, I think it's going to be a very challenging market to be trading.
Okay, so basically it doesn't seem like anything is coming to save us, but when you think about the project that this administration wants to undergo, it is turning around a really large ship to try to take trade deficits to zero, and arguably it's something longer than 4 years of a presidency. So how do you think about what the ultimate end to this looks like?
It's a really good question. From an equity perspective, I think there's a few things that, we're trying to assess here. One is just for the US, which is, how impactful could these tariffs be? Now, look, one of the interesting things I think is that, at the beginning of Trump's administration, he was focusing on this 60% tariff on China or a universal tariff. The fact is that we've gone down this universal tariff route, and that to me is really worrying because the ability for companies to pass on that cost or to use supply chains to navigate this is kind of gone. Everything's just raised up. So US corporates are getting, squeezed right now. And it doesn't feel like this is an economy where they have much pricing power either.
Right.
Now, I do think from a longer term perspective, what we could see structurally is a rotation of flows out of the US into international markets. And I do think we're getting to this point where I wonder whether we're on the precipice of a structural rotation of global equity market flows.
Okay, that is interesting because, again, if we were to go into the economic textbooks, it would say those with the trade surpluses are the ones that suffer when tariffs are put in. So places like China, maybe even Europe, it's not the U.S., sorry, it's those that suffer the most. The U.S. would benefit. Are you saying that when it gets put into practice, it will be the opposite, that it is the U.S. that suffers the most and internationally does better?
Well, it could be, and this is where there's so many moving parts to all of this, right? So take China. They have policy stimulus. They're going to come through. They've already did this at the NPC meeting, expand their fiscal deficit. They've targeted 5% GDP, which means that if things get worse, they can do more. Again, take Europe. Germany's done their fiscal stimulus. They've announced their infrastructure fund. I think you guys in Bloomberg did a great report talking about Europe is potentially doing broader fiscal stimulus as well. And then take the US. Well, the US is actually trying to cut back on their fiscal deficit, right? And so this is where all these moving parts are coming, where it's like, at least other countries in the world have a policy offset. And you could say that there is, you know, again, if you're a foreign investor, why would you want to have your money in the US? Why might you not want to, you know, bring it back home? And is there just generally a bigger domestic bias from retail investors globally?
Well, this kind of brings it back to the point about COVID. You mentioned it. The different thing this time is COVID was something we didn't want and something that governments reacted to.
Yeah.
This is something the government wants, and as you say, aren't going to provide stimulus into the system.
Completely.
So what does that mean for our understanding of how to even trade this? Is there any sort of historical analog that you can look back to? Are we just in completely uncharted territory?
There's no tariff playbook, you know, to this extent.
Yeah.
And so I do think we're in completely uncharted playbook. And so that's, again, why we're just going to see this market, which is almost forcing, you know, the policymakers' hand to see, like, where is the floor? Like, where is the pain point where the Fed or the government is going to step in and provide support? And what we can see from your reports over the weekend, we don't seem like we're there anytime soon.
So to be clear, if we're not getting it from the government, would you wait to buy any sort of dip until you see Powell seriously talking about cuts?
I mean, I think from a positioning perspective, we could see a tactical bounce maybe tomorrow. But, you know, is that going to be a day? Maybe. Do I think for the next few weeks we're going to sort of see a market that grinds lower? Definitely. And I think, as you say, we need to see tangible, you know, noise from policymakers talking about either a withdrawing of tariffs or the Fed stepping in for markets to feel more comfortable at this point.
Well, so in the meantime, as you say, earnings are going to be a mess. I mean, it is going to be really interesting to listen to these earning calls when you've already have companies talking about force majeure, not filling out their contracts because of that.
Yeah.
What does that mean for this goal of getting companies to come back into the U.S. and building? Is there anyone that's going to be willing to commit the CapEx to do that right now?
Well, I mean, you've seen that in a number of examples where TSMC, Honda has committed CapEx to the U.S. and you know, nearshoring or reshoring to the U.S. You know, that would be an interesting development, but it's interesting that that time frame is so long. You know, it's like 5-10 years down the line. So that's definitely something which is problematic. But as you say, I think the real problem for the US earnings season is going into the fact that Q1 is a low earnings hurdle to beat. I think it's 7 to 8% Q1 decline. But that doesn't really matter because what we're going to be looking at is guidance, and guidance is just going to be either withdrawn or, you know, no one, I think, has any incentive to provide positive guidance at this point.
I mean, it is so true. Who cares about Q1 when we are living in a new world right now? Sir, thank you so much for joining this morning. Good luck for the rest of your week. I think we're all going to need it. That is HSBC's Alistair Pinder. Okay, let's get to some other top stories that are trending on the terminal this morning. President Trump says that China's objections to the new U.S. tariffs have stalled a deal to sell off TikTok to keep it operating in the U.S. Before Trump announced widespread tariffs, the deal was reportedly close. The president previously had said that he would be willing to cut a deal with China to lower tariffs if the country agreed to a TikTok sale. Japan's Nikkei entering a bear market for the first time since August. Japanese Prime Minister Ishida told Parliament that he would strongly urge President Trump to drop the planned U.S. tariffs on Japanese imports. Sources say that Ishida is trying to hold a call with the president as early as tonight. Bill Ackman and Stanley Druckenmiller have slammed President Trump's decision to launch expansive global tariffs. Ackman says the new trade regime is a mistake. Druckenmiller expanded on criticisms that he made on the policies from an interview of January. Bloomberg News, though, couldn't independently verify Druckenmiller's account. Coming up, Tesla extends losses. One of the biggest bulls on the street has slashed his price target by, get this, 43%. We're going to have more on that call next.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
You cannot throw away the real possibility that it is a severe recession, because there's so many changing parts and retaliatory moves, and Smoot-Hawley it was not the cause of the Great Depression, but it certainly accelerated how painful it was. And so I think about it in probabilistic terms. We talked about the probability of recession. There's also the severity, and the tails for how bad it can be are much fatter than in my prior experience when I was thinking about a slowing economy.
Boaz Weinstein, founder of Saba Capital, speaking for the upcoming series Bullish on Bloomberg Originals with Sonali Basak. Let's get a check on these markets, because we are down more than 3% for your U.S. stock futures session. When it comes to commodities and oil, we are also down sharply, nearly 4% for NYMEX crude, dipping below $60 a barrel. Saudi Arabia has cut its oil prices, and oil majors also following suit in that decline in the pre-market trade. Joining us now is Bloomberg's Jomana Bersecci. Jomana, it's getting ugly out there.
It's not pretty, Danny. Another 4% almost of declines in the oil complex today. That brings the tally of the last 3 days to 16%. And I thought this was a really interesting statistics from Morgan Stanley earlier today. They put out a note saying that 2-day declines of 12% have happened 24 times in history. 22 of them coincided with a recession. So that probably tells you a lot about what this oil market is pricing in right now. But the catalyst, how did we get here? Well, number one, obviously, the big tariff announcement last week, which caused the market to get quite concerned about the demand outlook, with many analysts out there slashing their forecasts for GDP growth for China, Asian economies, Europe, and of course the US as well. But the second blow came towards the end of the week with that OPEC Plus shock announcement to bring forward the extra production and roll in 3 months of extra production into 1 month. Nobody was expecting that on the streets, and that was the catalyst for that subsequent double-digit decline in the price of oil that we've had over the past couple of days. Now, over the weekend, the negative news flow continued. We also got word that Aramco, which are obviously very influential in Saudi oil markets, have now cut their official selling price of oil to Asian economies by the biggest drop since 2022. And so this tells you a lot also about how Saudi Arabia is thinking about market dynamics here. And there seems to be more emphasis these days on maintaining that market share as opposed to keeping some price stability in the market. And to your point earlier, it's not just about what's happening in the spot oil complex, it's also having huge ramifications on energy names, the energy industry. Many of these shale producers in the US are getting hit as well. You've got names like Halliburton, Liberty Energy down anything between 20 and 30% just in the last couple of trading sessions. So I would say that the mood out there for the industry is pretty negative and downbeat at the moment.
And it also complicates President Trump's goal of drill, baby, drill. If you have these energy companies in the U.S. which are suffering so much. Jomana, in this uncertainty, what has been the reaction? What are we hearing from industry players on how they see moving forward?
Yeah, you know, there was an interesting piece in the Wall Street Journal today, and the title was President Trump pledged to bring down oil prices, but perhaps not quite like this. This isn't what the shale producers were really hoping for, especially with this steep decline in the price of oil, which for many actually makes the economics of drilling just not feasible. Many analysts out there are also downgrading their views. Interesting today to hear from Goldman Sachs, the second time in the past week they've cut their forecast for Brent. They now see it averaging $62 by the end of this year, $58 next year, so even lower than where we're trading right now, citing again the possibility of further OPEC plus supply and the possibility of recession. They've also been upping their recession odds. Morgan Stanley also downgrading their Brent forecast by $5 for this year as well.
Jomana, we really appreciate it. That is Bloomberg's Jomana Bersecci on the latest in the oil market. Let's turn to Tesla now, because shares are dropping in the pre-market session, down 6.5%. They are below they are at $224. If they were to extend, as they did at one point, but below $214, that's the price that Commerce Secretary Howard Lutnick predicted that they'd never fall to again. But again, they did fall to that point at one point this morning. Now, adding insult to injury, bullish investor Dan Ives of Wedbush slashed his price target for the stock by 43%. He cited a brand crisis created by Elon Musk and President Trump's policies. He said, quote, Tesla has essentially become a political symbol globally. It is time for Musk to step up, read the room, and be a leader in this time of uncertainty. Joining us now is Bloomberg's Craig Trudell. And Craig, this is something that Dan Ives had said he would do unless Elon Musk got back to Tesla. Now, there seems to be some reporting that he might slowly be less involved with the White House, but just how tough of a go of it is it for Tesla at this moment?
Well, I think Ives's note just yesterday was really remarkable to me, because just roughly a month ago in early March, he was calling Tesla, one of Wedbush's best ideas, and in his note referred to this stock call being a table pounder. He really viewed this idea that Tesla's sell-off was overdone, that all of this concern about brand damage that Musk was maybe doing was overstated, and sort of look on the bright side of all these things that Tesla has coming. I think he still is really emphasizing the opportunities that Tesla has ahead in terms of new product introductions and the hopes that they're going to have a robo-taxi service in the months to come. But he's really sort of changed his tune in pretty dramatic fashion about going back to that brand issue. And I think his call here last night was really sort of worrying about the idea that in China in particular, that with the level of tariffs that the Trump administration has put on China, that will have some blowback for the company in its second biggest market and lead more consumers to buy domestic instead of buying Teslas.
It just underscores how even executives that are close to Trump, the closest of one being Elon Musk, aren't protected in a world with more tariffs. Craig, we've seen reactions from the likes of Jaguar Land Rover, who's pausing U.S. shipments. What has been the reaction of automakers that rely on the U.S. market so heavily? What are they doing in this moment of increasing tariffs to a level that many did not expect?
Yeah, I think that was a huge development over the weekend, because Jaguar Land Rover is, sort of neck and neck every year with Nissan as the biggest manufacturer here in the UK. And for them to go so far as to actually pause shipments to the US, which, North America is their biggest market, that's a huge deal for this company and for the parent Tata Motors. And I think it's sort of, indicative of this broader move by the industry the last few days of just total chaos, where you've seen some manufacturers try to cut prices to keep consumers kind of reassured. Others, like Volkswagen, for example, they're going so far as to actually list on the stickers an import fee. So it's really a matter of all over the place chaos for the manufacturers.
Craig, thank you so much. That is Bloomberg's Craig Trudell. As stocks sell off pre-market, we're continuing to look at that S&P 500 futures down more than 3%. HSBC out with a note this morning from Max Kettner saying that we are now in oversold conditions, and you could make the case for a turnaround Tuesday, very short-term bounce, though they say this isn't over yet. You're looking at a 10-year yield that's down 4 basis points. The front end, though, leads lowered. We're lower by 10 basis points for your 2-year yield. Coming up, we'll set up your week ahead.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
For your trading week. Later today, we are going to be hearing from BlackRock CEO Larry Fink. He will be speaking with Bloomberg's Eric Schatzker at 12 p.m. at the Economic Club of New York. Then President Trump and Israeli Prime Minister Benjamin Netanyahu will be meeting at the White House on 1 p.m. And then Wednesday, it is the higher U.S. tariffs that take effect on imports in more than 50 countries and territories, plus U.S. CPI numbers. Those come out on Thursday. A quick look at how stocks are reacting this morning. Another tough day overall, but we're looking at Mag 7 continuing to fall. Amazon, Microsoft, and NVIDIA all down at least 3.5%. The banks also under pressure. They had their worst 2 days since March of 2020, falling across the board more than 4.7%. Citigroup, Goldman Sachs down 5%. It is recessionary pricing that we are pricing in. All right, that is it for your brief surveillance. We'll take things from here.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Financial markets are incredible discounting machines, and they're discounting the future story, and that's really about this tariff story.
If these tariffs stay, all bets off, because it changes the whole paradigm.
There is a hope trade, though, in the market. I think the hope is that this is the start of negotiation, and that this is actually not going to stick.
Tariffs are going to be high, and I think they're going to be high for a while.
The hardest thing for the markets right now is not only to try to evaluate where the destination is, but how bumpy will the journey be?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Shall we get your week started? Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, and the White House isn't backing down.
Because of the tariffs, we have $7 trillion already committed to be invested in the United States. What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. I don't want anything to go down, but sometimes you have to take medicine to fix something.
The president's sticking with the game plan. Baseline tariffs are active, and additional tariffs kick in just a few days' time.
There is no postponing. They are definitely going to stay in place for days and weeks. The president needs to reset global trade. The countries of the world are ripping us off, and it's got to end. The president has made it crystal clear. This is the policy we are going to protect. The factories that come build in America, we are going to protect them. They're going to be successful.
That's sending the S&P 500 towards a bear market and fueling fears about an economic downturn. The Treasury Secretary rejecting the idea that we're heading for recession.
I see no reason that we have to price in a recession. I reject that assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week. What we are looking at is building the long-term economic fundamentals for prosperity that I think the previous administration had put us on a course toward financial calamity.
This administration has had its say. This week, it's corporate America's turn to have its voice. Delta results are out on Wednesday. Big banks are dropping on Friday. Earnings season is just around the corner.
How do they give guidance at a time where there is none? This is going to be a pivotal couple of days before we get that potential guidance from companies. To me, really, the quote of the morning comes from Deutsche Bank's Jim Reed and David Fokerts-Landau over at Deutsche Bank. At the moment, there are few signs that this administration are backing down. Where are the off-ramps? Rarely, if ever, have the next few days been so important, John.
We spent the weekend debating one question. Is this the beginning of a negotiation, or are these the new rules of the game? I think after the weekend, we're starting to lean away from the former and much more towards the latter.
If these are the new rules of the game, what does that mean for global trade? What does that mean for the U.S. economy? What does that mean for the global economy? Lower. That seems to be the message from markets. You can say whatever you want, that markets have it wrong, that markets are influenced by globalists. You can say whatever you want, but right now, the unabating message from global markets worldwide is that this is going to suppress growth and potentially on the margins increase inflation, but it's less an inflation story than it is really something more of a recession.
Where does it leave the bond market? 2-year, 10-year, 30-year. So a bit into twos. Yields down to the front end, 8 basis points. On 10s, people running around screaming recession, and your 10-year bond yield is lower this morning by just 3 basis points.
That's exactly the point that I think is the right one. This has been a real question as we do face a fiscal cliff in the United States. How much of a haven can long-term bonds be? Let's say there is a recession, and here comes the fiscal question. How much room does the United States have to borrow to support an economy at a time with a fiscal deficit at a record high? And this is the tension that you feel in the 10-year that's keeping it from going even lower.
Equities recovering just a touch. We're still lower by 2.8% on the S&P 500 this morning. Coming up this hour, Chris Verona Strategas as the sell-off deepens, Ed Mills of Raymond James as some countries push to negotiate, and Justin Wolfers of the University of Michigan as Secretary Besson dismisses recession concerns. We begin this hour with stocks falling following their biggest two-day drop since March 2020 as President Donald Trump defends his tariff plans. Anne-Marie was on Air Force One with the president over the weekend. AMH, he remains defiant.
He remains defiant when it comes to his tariff plan, Jonathan. I think one of the key messages the president said to us reporters last night was, I'm willing to make a deal with China, but they have to solve the surplus. He then also talked about the European Union, this idea that the United States no longer wants to have trade deficits bilaterally when it comes to trading partners. And for me, that feels like that is a new line in the sand, and whether or not this question of this is a negotiation or no rules of the game. I asked the president that specifically. He didn't want to answer that question. One question he was willing to answer was whether or not there was this idea of what Trump put. Is there a threshold that this administration is willing to tolerate and be willing to maybe to try to talk up the market, talk about having deals done, maybe not have these tariffs enacted on these high rates? And the president said, of course, he doesn't want to see anything go down, but he called it necessary medicine. He said he was elected on this. So that's where this White House is left today. There's reports in Japan that potentially we can have a call this evening in Japan, in the morning in Washington, D.C. with the Japanese prime minister. The president told us over the weekend he heard from a number of leaders, European, Asian leaders. He spoke to 4 or 5 tech CEOs, but he remains defiant in what he is doing in terms of the tariffs, and those tariffs look to go into effect.
Anne-Marie, thank you. Much more from Anne-Marie throughout this morning, live from Washington, D.C. Mentioned Japan, the Nikkei closing down by close to 8 percentage points lower. In Europe, the DAX at the moment, Lisa, down by close to 5.
Given the fact that when the U.S. sneezes, the rest of the world catches a cold, you are seeing a ripple effect around the world. Initially, there was a feeling that maybe the U.S. would be the epicenter. What we're seeing in markets right now, not necessarily the case.
Let's extend the conversation. Chris Verona Strategas, a Baird company, writing the following. The S&P's trend is likely to turn negative. It empirically changes how we think about the market's character and raises the bar for what's necessary out of any rally. Chris joins us now for more. Chris, good morning.
Good morning, John.
Where do you want to begin? I think we start with the bond market.
Yeah.
Where's the rally on a 10-year? Where is it?
Well, it's funny. We started the year by writing, be careful what you wish for. We thought yields would go lower, but we were worried about why. And I think now we've certainly learned why yields are down. I think, Lisa, you make a great point about this idea, why is the long end not lower? I think the long end is complicated here. I think the short end is very, very straightforward. The 2-year yield is screaming. I think it's screaming at the Fed. I think it's screaming at global central banks that they need to wake up here. The 2-year yield's 350, 345 this morning. You're, call it approaching 100 basis points below where the effective Fed funds rate is. That was enough in September to get the Fed to go with the S&P at an all-time high, with gold at an all-time high, with spreads at record tights. If that was enough then, it should certainly be enough now.
The 2-year might be screaming, and certainly there's people who are even pricing in an emergency rate cut akin to what we saw in 2020. But I want to sit on the long end for a second. Is that screaming, too, that this isn't going to be the same kind of buffer at a time where that fiscal overhang is a serious problem. Where is the fiscal response to any kind of downturn given the deficit?
Yeah, well, I think the fiscal response is unlikely to come here. I think you have a much greater chance that the fiscal response comes from either Europe or from China here. So the bond markets in that part of the world, I think, do look different. When you think about this dynamic between 2s and 10s, the message everywhere you look globally is curve steepeners. So you have fresh highs in 210s in Germany, fresh highs in 210s in Australia, fresh highs in 210s in UK, and here, I think the message of curve steepeners remains the most dominant trend in the market.
And what's that mean? I mean, in terms of going forward, the ability for nations to finance themselves, and what this means for risk
slower
assets.
growth.
Okay, right.
I think it's certainly slower growth. I think the short end in particular, when you look at 2-year yield, we always say in our work, who needs Fed speakers when you have the 2-year yield? And the 2-year yield, I think, has been doing all the speaking that's necessary for what the Fed should be doing here. You know, you go back again to September, a 50 basis point cut against pretty benign conditions. And fast forward to today, it seems when you listen to Powell speak on Friday, he was a little bit too calm for the backdrop.
So whenever you have a moment like this one, you ask, where is the leverage? And if you think about the last 5 years, the leverage has switched to the sovereign balance sheet, which I think raises the question again about what's happening with 10-year treasuries here. No, I'm not going to sit here and say that in the next downturn, the bond market is going to sell off. That's not my call. I'm going to ask you if that's going to happen. In this downturn that we're about to experience, we go into it with budget deficits around 6%. We had budget deficits around 6%, even with unemployment at 4%. Yeah. What do people think is going to happen to the deficit if we go into a deep economic downturn?
Well, it's funny. It's not that budget deficits at that level in a recession would be that much of an eye-opening statement. It's the fact that we ran that in a relatively benign period of economic growth over the last several years. I think that's the concern. I would argue that's what gold has been suggestive of for so many years. In a way, maybe gold should be our scorecard here. I do find it interesting gold has reversed lower over the last couple days. I think that's a reflection of two things. Number one, for the last 2 or 3 years, gold's strength was sovereign buying, it was central bank hoarding. Over the last 4 or 5 weeks, that has changed. You have seen a surge of retail flows into GLD. I think that's likely reflective of the broader sentiment environment. But gold reflecting or gold reversing lower here also suggests this indiscriminate selling phase of the drawdown, right? What do we look for in these corrective, panicky moments? We look for indiscriminate selling, sell what you can. We look for capitulative price action. I think we're getting closer on that front. And we look for sentiment extremes. I think certainly you're seeing more of that over the last 72 hours.
And then we look for the policymaker to step in. You mentioned Chairman Powell. Absolutely no sign of that going into the weekend.
None. And I was going back over the weekend, going through all of our historical comps. Certainly 87. 1962, I think, is an interesting comp here as well. Even the Reagan drawdown in 81, I thought, was notable. The 87 move was really arrested that Tuesday morning when there was a statement from Greenspan just saying, hey, we're available. We're watching what's going on. I think we're still a far away from that when you look at what Powell said on Friday.
Does a Powell put have the same power that a Trump put would? I mean, it seems like this is asymmetric right now, given that Jerome Powell is dealing with an issue that is not created nor solved by a central bank.
Yeah, it's a good question, and we've kind of framed it as, is the strike price on a Powell put or a Trump put higher? I think we're going to learn here this week. Now, remember, we're down with the open today. We'll be down about 20% on the S&P, give or take. I think that does price in a lot of the immediate moment. Whether that prices in a recession down the line, that's to be seen. But down 20 in a matter of a few weeks does price in a lot. We are seeing, Lisa, what I would describe as, maybe not 08 capitulative action, but certainly kind of in the zip code of 2020, certainly in the zip code of 2011, certainly in the zip code of, say, 1998 LTCM.
So are you buying?
I think when you look at these moves, we describe it as a bang and a whimper. I think we're in the bang phase of this drawdown right now. High drama, high emotional. 85% of the time, these lows are retested somewhere between 4 weeks and 4 months down the line. We did a lot of work on this over the weekend. I want to buy the whimper. I think the whimper follows in the next number of months.
Hey, Chris, it's good to catch up.
Good to catch up with you,
sir.
Thank you.
Chris Cerrone there of Strategas, a bad company. The next Federal Reserve meeting, May 6th, May 7th. Bob Michael at JP Morgan Asset Management with us yesterday evening. Lisa making the case that the Fed might not make it to the next meeting.
And there are plenty of people who agree with him. Remember, that's what happened on May 3rd and then on March 15th of 2020 for the Federal Reserve. What would have to break, though, for that to happen?
Equity markets at the moment, and they're not blinking. Still, equity futures at the moment down by 2.4% on the S&P, slowly recovering and well off session lows. With an update on stories elsewhere this morning, let's cross over to Danny Berger for your Bloomberg Brief. Hey, Danny.
Hey, John. Hedge fund billionaires Bill Ackman and Stanley Druckenmiller have come out against President Donald Trump's decision to launch global tariffs. Ackman called the tariffs a mistake and said a 90-day pause is needed to resolve the U.S.'s historically unfair global trading position. In China, policymakers have discussed measures to stabilize the economy and markets in the face of President Trump's tariffs. Sources telling us that the measures will focus on boosting consumer spending, birth rate, and subsidies for some exports. They may also include a stabilization fund to support the equity market. Speaking of this equity market, longtime Tesla bull Dan Ives has soured on the stock. In a Sunday note, Ives slashed his 12-month price target on Tesla by 43%. He wrote, "Tesla has essentially become a political symbol globally, and that is a very bad thing for the future of this disruptive tech stalwart and brand crisis tornado that has now turned into an F5 tornado." And that's your brief. John.
Hey, Danny, thank you. The bulls are still bullish. Let's be very clear about that. John Stolfus of Oppenheimer came out over the weekend and cut his price target from 7,100 down to what? 59.50. 59.50 based on the close of Friday. We're talking about 15% upside. The bulls are still bullish. They're just repriced a whole lot lower.
At the same time, late last week, he came out and defended 7,100. He came out and said that he could still see almost 30% upside and talked about how this would blow over and there would be some sort of capitulation. How much credence can you give into the new price target?
I think they still need to capitulate, don't you, based on some of that?
Exactly, that's the point. This is the reason why we've seen consecutive cuts to people's outlooks in the matter of weeks.
Equity futures on the S&P recovering somewhat, still lower by 2.6%. Up next, negotiate or retaliate.
The fact is the countries are angry and retaliating. And, by the way, coming to the table, I got a report from the USTR last night that more than 50 countries have reached out to the president to begin a negotiation.
Up next on the program, Ed Mills of Raymond James, live from New York City this morning. Good morning.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Equity futures lower here, recovering somewhat though. We're down by 2.4% on the S&P. On the Nasdaq, we're down by 2.5%. Jamie Dimon of JP Morgan just releasing his annual shareholder letter. Lisa, while inflation has come down, most of what I see in the future is inflationary.
Yeah, he said the recent tariffs will likely increase inflation and are causing many to consider a great probability of recession. He called for a quick resolution, saying the quicker this issue is resolved, the better, because some of the negative effects increase cumulatively over time and would be hard to reverse the first time he has commented on the tariff policy.
Trade tariffs and trade policy at the epicenter of uncertainty. Under surveillance this morning, negotiate or retaliate.
The fact is the countries are angry and retaliating. And, by the way, coming to the table, I got a report from the USTR last night that more than 50 countries have reached out to the president to begin a negotiation. But they're doing that because they understand that they bear a lot of the tariff. And so I don't think that you're going to see a big effect on the consumer in the U.S. because I do think that the reason why we have a persistent long-run trade deficit is these people have very inelastic supply.
So here's the latest this morning. President Trump's economic team standing firm behind their sweeping tariff plan. European Union trade ministers meeting to outline a response. Let's head over to Luxembourg, where Ollie Crook is standing by. Ollie, welcome to the program. Let's look at this market in Europe. It's not being spared. Equities in Europe are getting absolutely hammered. How are the Europeans planning to respond?
What I think is very interesting, John, is before going into any of these meetings, before sort of setting out what their negotiating position, the trade ministers who just started to convene here in Luxembourg, what they're really trying to do is trying to reassure the European market, the European economies, that things are going to be okay and not to panic. Going into this meeting, you start to see kind of the nuances of what the conversation is and the different views that exist within Europe. And of course, one of the great disadvantages that the Europeans have here is they don't have just one person making these decisions. They need to come to consensus. We had actually a nice moment here. We had at the one hand the German economy minister speaking and the Irish deputy prime minister speaking. These are the two countries that basically make up the lion's share of the deficit with the United States. The Germans basically saying we need to be very aggressive here. We do need to negotiate. We do need to talk, but we need to put all of the tools on the table, including the anti-coercion tool. While the Irish are saying that is basically the nuclear option, and the single thing we need to do now is de-escalate. All of the Europeans would like to see a negotiated solution. Whether or not that is possible is a separate question. I mean, listening to Donald Trump over the last couple of days and the rest of the cabinet, I'm not sure that this is an administration that is ready to negotiate right now. It is possible also that the Europeans want to take a little bit more time, let the markets do some of the work to try to soften the conversation. But right now, this is the conversation that is happening with the ministers right behind me.
Well, the heat's on both sides. Ollie, appreciate the coverage as always. Check out the equity benchmark in Frankfurt, Germany. The DAX lower by more than 4 full percentage points. Anne-Marie standing by in Washington. Anne-Marie, any sign that this president over the weekend, any glimmer of hope for the Europeans, that he is willing to sit down and negotiate?
Not yet. I really gathered from this gaggle yesterday with the president on Air Force One that this pain he is willing to tolerate to get to better deals. And I believe the red line seems to be trade deficits. He went on really about China when it comes to trade deficit. He said, I'm willing to make a deal, but they have to fix the surplus. And Jonathan, when it comes to the European, it was very similar. And to get a bit more perspective on exactly where we could see this policy going, I'm excited to say I'm joined by Ed Mills this morning of Raymond James. Ed, thank you so much for joining. A big question we have going into this week is this a negotiating tactic? There's reports in Japan the prime minister will get on the phone with the president this morning, D.C. time, or are these the new rules of engagement?
I think it's a bit of both, and I think that they need more revenue to go to the tax cuts. I do think that this is a big part of trying to change policy, Anne-Marie, but I think that the problem for the president is that a lot of world leaders are not quite sure that they can negotiate with him. They look at the meeting between Trudeau, Zelensky. They don't want to be embarrassed. They also don't know what the president actually wants. He says he doesn't want a trade deficit, but there's some of these countries that will never be able to be at par. You look at Vietnam in particular. I think one of the saving graces potentially is that the only thing that is still not subject to tariffs are USMCA compliant goods. That was a deal that he struck in his first term. Is he trying to send the signal that if I negotiate a deal, that I am willing to stick with it? The more USMCA goods are excluded, the more he can lean into that argument.
But trade deals take years to hammer out. Is the damage going to be done?
That's the question for markets. And when I talk to folks at Raymond James is that they are concerned that what they thought they understood about President Trump is not what they're getting, that there is a big concern that the equity markets are no longer a barometer of his success, that they are concerned that he is going to be pushing for a change to the world global order that has existed since the end of World War II, and that they are concerned that he might go too far because his advisors are telling them in his first term, he didn't go fast enough, in that he wasn't able to do the change in the 4 years that he was president, in that there's a desire to go stronger, hold the course, and try to push for additional change that we were not pricing into this market.
Will there be legal or congressional challenges to the tariff plans?
I think that there's going to be both. I think with Congress has the ability under the National Emergencies Act to undo this emergency. However, it requires a veto-proof majority. We saw the Senate pass a resolution on the Canada tariffs last week. That was only 51-48. It was a majority, but not veto-proof. If he's not cutting deals, the tensions will grow. When you look to the courts, he used emergency powers.
IEPA.
Yeah, IEPA. Back in 1971, Richard Nixon did the same thing, used emergency powers to put a worldwide global tariff as we came off the gold standard. There was a strong argument there about an unbalance of payments. Then in 1974, Congress passed a trade act that said if there is an uneven balance of payments, the president's authority is to use what's known as Section 122, where you can put a tariff on for 150 days up to 15%, 1.5. This is not what the president did here. So did the president violate the congressional intent? Did the president use emergency authority when there isn't the subcontext for an emergency authority? The problem for me is that the courts almost exclusively never say that the president's emergency action was not legitimate, and that the beef might be with Congress, that the Congress has to make their action under the National Emergencies Act to turn off the emergency.
Staying in Congress, some good news for the administration was the fact that the Senate passed this budget. It's going to go to the House this week. When do you think we will see the extension of tax cuts?
So I'm always looking for a crisis or deadline in D.C. before we act. You look at Republicans, and they're trying to do this with the debt limit. So to me, that goes right up to the August recess, so probably the June-July time period. And when you look at that bill, what passed in the Senate was at least $5 trillion worth of tax cuts over the next decade, a $300 billion increase in defense and immigration spending. That would be the single largest bill in the history of the United States. And a lot of people look at this and say, all right, well, this is not going to be stimulative because it's a continuation of current policy. But when you add in the changes to no tax on tips, overtime, Social Security, extension of SALT, extension of the child tax credit, in the business tax credits, I can come up with a reasonable argument that over the next year or two, that's somewhere between $500 billion and $1 trillion of additional stimulus. That's where the market is going to say that's the bull case from here, especially if we start getting some of these trade deals struck.
Ed Mills, thank you so much from Raymond James. Jonathan, though, tariffs in focus, and he says it's a bit of both, negotiation and maybe new rules of the road.
Anne-Marie, thank you. Just to keep a tally of where the equity market is, at the lows we were down by 5%. Right now in the S&P, some of that weakness is being bought. We're negative by around 2.3% on the S&P 500. One note to watch a little bit later on this morning, 10:30 Eastern Time, you will hear from Governor Kugler of the Federal Reserve, the first scheduled Fed speaker, responding to the price action of the past few days and the headlines over the weekend.
Will she be as defiant, maybe, as what we heard from Fed Chair Jay Powell, who said the emphasis very much clearly is on inflation, not tackling some sort of impending downturn?
The Federal Reserve isn't blinking. Up next on the program, Anisha Sherman of Bernstein on the impact of tariffs on retailers. From New York City, you're watching Bloomberg TV.
case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can legally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Two-day slide on the S&P, down 10.5% in just 2 sessions. Thursday, Friday, moves we haven't seen since the pandemic. This morning, kicking off things Monday, we're down by 2.5. Overnight, down as much as 5. On the Nasdaq 100, entering a bear market into the weekend, we're down another 2.6% this morning. In the bond market, 2-year, 10-year, 30-year, front end of the curve, very straightforward. Pricing in some big moves from the Federal Reserve. Will we get it? That remains an open question. Yields down by 7 basis points. We're lower for an 8th consecutive session. Over that period, down by more than 40 basis points. The 10-year, far more interesting. Why isn't the 10-year maturity rallying? Yields, Lisa, 3.99.
You've raised this question. At what point is the risk, the credit risk in sovereigns, particularly the United States, where the deficit is so steep? There are a lot of questions as to why it's not rallying more. What it is clear to show is that the easy trade is the short end. Longer term, people are too confused to even make some sort of decisive call.
In this phase of the sell-off, it's always confusing because it could be a matter of sell what you can and not what you want. So these kind of moves can be misleading at times, but I think those questions around how bonds will respond in the next economic downturn deserve to be asked.
Especially because it's coming in tandem globally. It is not just U.S. Treasuries, and it's coming as there is a re-leveraging of the fiscal balance sheets of everyone other than the United States. So at what point does the U.S. yield curve become susceptible to trends elsewhere rather than the other way around?
Let's turn to crude just briefly. Brent and WTI. Brent crude is lower again. WTI as well. WTI crude is down about 16% in just 3 sessions. And yesterday, as soon as we started trading, Lisa, a break of 60.
Yeah, this is a really strange story. On one hand, this is the fact that an increasing number of Wall Street firms have projected recession as their base case, including JP Morgan with a 60% chance of contraction. On the other hand, there was a price cut by Saudi Arabia at the same time that there was an output increase. This is an interesting story, although it is reflected by commodities more widespread.
Crude down by 3%. Equity futures recover just a touch. We're lower by 2.6%. Let's get to your morning movers this morning. Let's cross over to Danny Berger with more. Hey, Danny.
John, there's no shortage of stocks under pain this morning to choose from. Breath is horrible. Only 10 stocks on the S&P 500 are higher in the pre-market session thus far. Banks under pressure. Goldman Sachs, the worst of the large bulge bracket banks, down more than 3.5%. Adding insult to injury, Morgan Stanley downgrading Goldman, saying that this is the bad kind of market volatility. It is one that is bad for investment banking and for money management fees, so those shares under pressure. Much like the banks, we're also seeing the private market players under pressure too. IPOs being paused, M&A frozen, Apollo down 4.33%. What does that also mean for the task of rebuilding America and the investment that some of these might be willing to put in? Now, lastly, rounding up with one of the worst stocks on the S&P 500 in the pre-market session. This is an interesting one. Off the back of a Reuters report, Howmet Aerospace is declaring a force majeure, meaning that they do not have to honor their contracts because of an unforeseen event. They supply a lot of crucial parts to plane makers, both commercially and military uses. Those shares down some 7%, underscoring some of the supply chain ripples we might yet see to come, John.
Danny, thank you. More from Danny later on this hour. On our radar this morning, President Donald Trump defending his tariff plans and dismissing recession fears. Trump also saying he wouldn't strike deals to cut the highest tariffs unless they eliminate the U.S. trade deficit with that country.
Which creates a real issue for people who are looking at this as a tactic to negotiate deals rather than a goal in and of itself. Because ultimately, how do you get no trade deficit with a country like Vietnam that doesn't have the capacity to buy as much from the U.S. as vice versa? It goes to the heart of what are the off-ramps to de-escalate this, and right now people are having a hard time finding any, especially as we get responses around the world.
To make it simple, going into the weekend, we sat here on Friday morning and we said, who blinks first? Chairman Powell. He didn't blink. Over the weekend, they dug in.
Yeah, and not just that. What I thought was most interesting was the TikTok deal. It was supposed to get done over the weekend. It didn't. It got pushed 75 days. Otherwise, it would have been banned in the United States. And there was a Bloomberg report talking about how China hardened its stance after the announcement of tariffs on April 2nd, that they had been taking a really subdued approach and that they shifted because they were personally insulted and felt like we cannot negotiate with this person. So how do you take this and de-escalate it when it already has taken on a life of its own?
I don't think anyone was surprised by the TikTok news. We sat here on Friday and we all said, who are they negotiating with? Maybe there was a deal. A deal with who? Because it certainly didn't involve the Chinese going into the weekend.
If you want to take a silver lining, and last night I was looking for silver linings.
You find one?
Maybe it was that it was postponed and it wasn't just, killed outright and there wasn't the sense that it was banned. But you're right. It's not a huge surprise. That said, reporting said that there was a deal in place, but China decided to withdraw at the last minute.
Let's sit on China. Policymakers discussing accelerating plans to unleash stimulus in response to President Trump's tariffs. Sources telling us here at Bloomberg the measures will focus on boosting consumer spending, the birth rate, and subsidies for some exports. So they've got a number of options with regards to the tariffs. They can retaliate. They've said they would. They could capitulate. They might. They could turn around and say we're going to devalue the currency, or they could lean on fiscal. That's the list on a menu right now. What do they pick?
And how about all of the above? And that seems like maybe there's going to be a little bit of all of the above, except maybe not negotiating as quickly as they are going to pull these other levers. The fiscal measures that have been proposed are interesting in how much they differ from the past ones. They have to do with boosting consumer spending, the birth rates, as well as subsidies for some exports. At what point is this the counter response that will give people confidence to go elsewhere and actually have an attractive investment proposition? That said, the Chinese market's down, what, 13% right now?
The Hang Seng down 13%, the CSI 300 down 7%. Ugly session. It missed the gap lower on Friday, but certainly they're in the crosshairs as well.
And so it seems like to the extent that there is some sort of stimulus, there is some sort of response, market traders are not saying that they're going to be immune from this pain.
Let's get to the bulls on the south side. Tesla and the big bull, Dan Ives of Wedbush, cutting his price target on the stock by 43%, saying the company has become a political symbol, writing, quote, "It is time for Musk to step up, read the room, and be a leader in this time of uncertainty." That name is down again this morning by around 4%.
Yeah, and we have heard on the margins that Elon Musk is going to step away from the administration. A key question now is how much influence does he have over policy? Elon Musk told Deputy Prime Minister Matteo Salvini, both Europe and the U.S. should move, ideally, in my view, to a zero-tariff situation, effectively creating a free trade zone between Europe and North America. And then Peter Navarro, in an interview on Fox News, came out and said that that is simply a tech mogul who doesn't understand the complexities of trade and that he sells cars and should stick to it.
Some tension between the two.
Very clearly.
I noticed the same thing. I wonder who wins out. I think that Elon Musk was tweeting as well this morning, posting rather on X, mentioning an argument against tariffs, which is a timely one to post, that's for sure.
How does he stack up at a time when his own people are telling him, hey, these are going to hurt us, and his stock is tanking?
That's the latest on Tesla. The latest on the equity market, continuing to recover, still lower by 2 full percentage points this morning. Let's turn to retail. Shares of U.S. sportswear companies tumbling in the pre-market. Anisha Sherman of Bernstein writing, a U.S. recession stagflation scenario will hurt all discretionary goods names. Big brands would face higher risk of slowing consumer demand, while fast-growing brands with a compelling product and right to gain share in the US are more protected, at least initially. Anisha joins us now for more. Anisha, welcome to the program. I just want to understand from your perspective what these retailers and some of these sportswear brands do on day one. Are they putting prices up immediately? Are they pausing production? What are these companies doing?
Well, you have to remember that some of the inventory that they have on hand is not subject to tariffs. Whatever's already in the United States, whatever's already en route to the United States, on ships, on containers right now, is not subject to tariffs. So they do get a little bit of a reprieve for at least the current quarter and perhaps some of the subsequent quarter from inventory that's already en route. So the first initial move that we have heard from the industry is they are trying to get as much onboard vessels as possible before April 10th. So just to get the tariff-exempt product on board. The second move is likely going to be pricing, but I don't think we will see a sticker shock of pricing across the board. I think it will be more new product that is introduced will be introduced slightly higher price points. Nobody wants to be the price leader here as demand is starting to slow down. And so companies are going to be very hesitant on pricing. The other thing they're doing behind the scenes is they are renegotiating up and down the value chain to try to share some of this pain. That means renegotiating with their vendors, which are in some of these countries in Southeast Asia, as well as renegotiating with their customers, which are the big retailers, sporting goods retailers that sell their product. They did this 2 years ago when freight costs went up. They shared the pain up and down the value chain. They're going to be doing this again.
What I hear is a lot of absorption of potential cost from these tariffs. What I don't hear from you is the idea of moving production back to the United States. Is that on the table for any of these retailers?
I don't think that is a realistic scenario. From a timing perspective alone, it would take at least 1.5 years to set that up. From a cost perspective, it is not feasible. Given where labor costs are, given where supply chains are, it's unlikely to do. And especially for specialty apparel and footwear, where you have particular shoe molds, particular styles, particular capex that some of these suppliers need to invest in order to produce, for example, a performance running shoe. You're talking about years of investment before you can get something like that up and running, not to mention the cost of it. So I don't think that is a realistic scenario that brands are considering.
Anisha, you mentioned the demand aspect, which is the harder thing to gauge, especially at a time where right now, at least in backward-looking data, the consumer is fairly strong. I just wonder, at what point does it become cost prohibitive to pass along any price increases whatsoever, given the fact that a lot of people in the soft data are already expressing concern about their jobs, concern about their costs, and concern about the economy?
Absolutely. And this is where, you showed my comments up on the screen earlier. I mean, this is where I think it really depends on which brand you're talking about. If you are a big incumbent brand that is already facing a slowdown in demand, many of the brands and retailers in this first quarter commented on that. They already saw a slowdown in their traffic trends. They're seeing sentiment come down. It's going to be harder for them to pass on a price increase. However, smaller brands that have a compelling product that is selling through at full price and have kind of the right to gain share in the U.S., have a little bit more of an edge here, especially when they are premium priced and appealing to a more higher income consumer that is not going to be the first one hit from massive inflation in the US. So there's some difference here where I think fast growing, premium priced, premium and luxury, smaller brands will be able to pass on some price increase, whereas the big incumbents will struggle to do so.
So Anisha, as some people wake up this morning and look to pick up some of the pieces, the equity market recovers just a touch. It's down by 1.7% on the S&P. What are your top picks? What are those names that you and the team are looking for?
Yeah, so into this downturn, I think we would look for names that have a compelling product or brand, that have pricing power, that have a higher income consumer, so less exposure to low income consumer, and that have demonstrated pricing power and the ability to pass on some of that price. And those names in my coverage, I like TJX. They are going to be a recession winner. They're going to be a trade down winner. They've done AUR increases for the last 4 years, and they can pass on in a discrete way some price increases. I like Tapestry. That is a affordable luxury Coach brand, which is a trending brand at the moment. They've done price increases for the last several years. They could easily pass on the bulk or most of this, most or all of this tariff increase. And I like On, which is a small footwear brand, which has low market share, a premium product, again, pricing power in the U.S., and a strong sell-through that shows no indication of slowing down so far.
Anisha, great to get your thoughts. Appreciate your time. Busy week coming up for us all. Anisha Sherman there of Bernstein on some of the retailers. Lisa, I'm pleased you brought up the factory question. It's such an important one. We talked about this repeatedly with regards to Vietnam. Wage differentials are so large. The prospect that these factories are going to move, even with tariffs north of 40%, the prospects are still pretty low for some of these industries.
Which is by design. I mean, how do you end up recreating not just the factories and building them out, but also the ecosystem of people trained to manufacture some of these things? That's why people are looking at Apple in particular, and whether they will increase the cost of their iPhones, given the fact that they have to either pass along the tariffs or find different production than mainland China.
Equity futures recovered just a touch with negative hit by 1.7% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. JP Morgan Chase CEO Jamie Dimon is urging a quick resolution to what he called tariff policy issues. In his annual shareholder letter, Dimon wrote, "The quicker the issue is resolved, the better. Some of the negative effects increase cumulatively over time and would be hard to reverse." Dimon predicted an increase in inflation for both imported and domestic goods. Meanwhile, billions of dollars worth of IPOs are on hold as President Trump's trade war upends the global economy. Sources telling Bloomberg that ticket platform StubHub, fintech giant Klarna, and trading platform eToro have all paused their planned listings as markets extend deep losses. Israel's Prime Minister Benjamin Netanyahu will meet with President Donald Trump in Washington in order to seek a better tariff deal. The two will also discuss the war in Gaza, the situation in Syria, and the Iranian nuclear program. Netanyahu will be the first world leader to meet Trump since he announced tariffs on more than 60 countries. And that's your brief. John.
Danny, thank you. A news conference a little bit later on that front. That's going to be must-watch. Equities then recover a touch. We're down by 1.5% on the S&P. Up next, the White House remains defiant.
I see no reason that we have to price in a recession. I reject that assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week.
That's one view. Here's another one. Justin Wolfers of the University of Michigan joins us next. Live from New York, you're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I didn't really. Go.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
equities off the lows, down 5% overnight, now down by 1.7 on the S&P 500. Lots more cuts to price targets across the street, including from Evercore. Julian Emmanuel down to 5,600 from 6,800. Oppenheimer of John Stolfus down to 5,950 from 7,100. That's a big adjustment from him. What once sounded bearish, though, is now sounding bullish. Targets, Lisa, like 5,950, 5,600 from where we are. People would take that right now, they'd rip your arm off.
Especially given that some of the downside projections are for 4,200 in the case of a recession, that according to Lori Calvasina. Morgan Stanley's Michael Wilson is saying that maybe the S&P could sink another 7 to 8% if these tariffs remain in place.
If you're just joining us, welcome to the program. Under surveillance this morning, the White House remains defiant.
I see no reason that we have to price in a recession. I reject that the assumption there doesn't have to be a recession. Who knows how the market is going to react in a day, in a week. What we are looking at is building the long-term economic fundamentals for prosperity that I think the previous administration had put us on a course toward financial calamity.
So here's the latest this morning. U.S. Treasury Secretary Scott Bessent rejecting the idea that these tariffs will cause a recession. Justin Wolfers of the University of Michigan writing, these tariffs are going to hurt a lot. They're going to reshape your life in much more fundamental ways. I'm pleased to say that Justin has given us some time this morning. Justin, good morning to you, sir. Let's just breathe some life into that quote. When you say this is going to change people's lives in fundamental ways, what do you mean?
Mate, next time you walk through the supermarket, just pick up that box of cookies or that pasta or that avocado and just look on the side for where it's made. Even when it says whether it's made in America, think about where the raw ingredients came from. And very quickly you'll discover that every part of our lives is profoundly integrated with the global economy. And what we now have is, on average, 20% tax on every interaction we have with the rest of the world. So we're going to have to shift what we buy, we shift how much we can afford, you know, the rest of the world's off doing business with each other. This is a shock very much on Americans.
Justin, you said small tariffs create small problems and big tariffs create huge ones. How much of this is just simply price increases? How much is this a real crimping in the economy? And how much is this actual supply chain disruptions akin to what we saw during the pandemic?
Yeah, so, Lisa, this is one of the few networks where I can actually come on and talk about it this way. There's something I hope your viewers remember from when they took introductory economics, which is that the cost of a tariff rises in the square of the tariff. So, you know, when we move from 1% to 2% tariffs, which is basically what we did under the first Trump administration, it's just not a big deal. You know, if a 2% tariff can lead you to switch off buying something, you probably didn't want it that much anyway. But now we're moving all the way up to 20% tariffs. And so by my calculation, that means that the second set of the tariffs in the second Trump administration will literally be 50 times more painful. To put it in simpler language, in the first Trump administration, if things became a little bit more expensive, you know, you could sort of soldier on and a percentage point here and there, you're not really going to notice. Here, every time you go to purchase something, every part of your supply chain, every store you visit, you want to ask yourself a question before you walk in. Hey, do these prices make sense? Can I afford to keep doing this? Ought I be looking at a substitute, even if it's a substitute I don't like as much? And that's the sense in which this is really fundamentally going to change every part of our lives.
Which raises the question of what the bigger risk is right now. Is it stagflation or is it recession? And people have been asking this question. Initially, stagflation was the main case. If this really does suppress demand, at what point are we just talking outright recession?
Listen, I think one of the hard things to do right now is to interpret the news that we're getting. So realize that stocks have fallen 12, 13% over the past few trading days. But realize they'd already priced in their best guess at what the Trump tariffs would look like. And even right now, they're pricing in a very large probability that Trump backs off. So if you took all of that out, that suggests that markets believe that the cost of these tariffs are much, much larger than the 12 or 13% that markets have subtracted as a result. So if they got clarity that Trump were going to stick with this, it would be even more calamitous. look, you raise a really important question, which is it's a very, very asymmetric set of risks. And so here's the thing Trump doesn't understand, which is he remembers from when he was young that there were there were large trading barriers with a number of countries. That's simply not true. We had decades and decades of trade liberalisation, and it's no longer true. So, look, heads we win. We can get a country like Vietnam to get rid of its tariffs. But realise the gain there is Vietnam's going to reduce its tariff rate from 1.1% to 0. Tails we lose, we're facing 34% tariffs on trying to export stuff from China. So this is a game where there's not much to win, but there's a whole heck of a lot to lose.
Justin, can we sit on the sources of inflation and the potential for further price increases? When you look across the economy at various industries, and you mentioned food production repeatedly through this conversation, are there certain industries where demand will be high, but capacity will continue to be low and constrained here domestically in the United States that you would worry about in the coming months?
Mate, I'm just going to tell you, I'm not very good getting down to the sector-by-sector stuff, so you've got all sorts of really smart analysts, and so I reckon you ought to pose it to them.
I'm sure I'll ask them that question, and they would probably point to what you've pointed to, food production, and that could be the issue going forward from here. That raises the question about consumer price tolerance, Justin, and maybe you can speak to that. This is going to be the interesting interplay for us as we watch financial markets and how corporations respond in the coming days. The interplay between margins, whether they'll absorb some of this or whether they'll pass it on, consumer price tolerance. Are we in a different phase of the economic cycle compared to where we were several years ago when consumers could absorb some of the higher costs?
Mate, we're in a very different place. So, first of all, during the last downturn, we had enormous amounts of government support coming. And more to the point, we had, through 2021, a government that, whether you like it or not, appeared to be competent on its face. We had no surge in economic uncertainty. Look, one of the things that's really unnerved all of us over the past few days is not just the tariffs. It's the clown show that's come with it. It's tariffs on penguins. It's setting tariffs proportional to the bilateral trade deficit, which no economist on earth will tell you is defensible. And then it's sending out the entire cabinet to the Sunday shows where each one of them on a different network gave a different rationale for what's going on, basically leaving us all with the conclusion that the global economy is being held hostage by the whims of just one man, which is not usually how we like democracies or economies to work.
Justin, I appreciate your time, sir, as always, and your honest response, as always. Justin Wolf was there at the University of Michigan. The president offering his honest view of things. He says oil prices are down, interest rates are down, the slow-moving Fed should cut rates, food prices are down. Lisa, there is no inflation.
Yeah, and then saying the long-time abused USA is bringing in billions of dollars a week from the abusing countries on tariffs that are already in place. This is doubling down on the message that he already has put out there, which is this isn't a problem, wealth will return, and that right now there's no reason to back away.
Just to reiterate, the president is not blinking. And equity futures roll over just a touch. We're down by 2.3% on the S&P. Up next, Dan Skelly of Morgan Stanley, Henrietta Trays of Veda Partners, Kamaksha Trivedi of Goldman Sachs, and the former senior Trump trade advisor, Kellyanne Shaw from New York City, the second hour of Bloomberg Surveillance. Up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, There is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Look at this as a shock to the economy.
It doesn't seem like we're going to get relief quickly.
This is a serious moment. I do not think the Fed can just sit on the side.
All of this could change with one headline, for the better or the worse.
Once the snowball starts going downhill, you can't stop it.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Nobody's blinking. Chairman Powell into the weekend did not blink. The administration over the weekend dug in. Equity futures this morning negative by 2.2% on the S&P 500, down as much as 5 overnight. The losses continue. On the Nasdaq, we're down by 2.4. On the Russell, we're down by 3. In the bond market, 2-year, 10-year, 30-year. For an 8th consecutive session, the 2-year yield is lower, down by more than 40 basis points over that period. On a 10-year, though, you're not getting much comfort here. We'll debate this through the hour. We're only down by 2 basis points on 10s. We're up 2. On 30s, your week ahead looks like this. Retaliation on the cards. Reciprocal tariffs kick in just 2 days' time. A day later, China is set to retaliate. The same morning, we get US CPI. Then later in the week, bank earnings. Corporate America gets its say and where it thinks this economy's going.
And what it's doing ahead of that, because it doesn't afford to be able to just sit tight and watch it happen. Corporate executives need to make decisions. They need to figure out who they're going to hire, where they're going to cut back, and how they address some of these tariffs. Look, there is a real question here about when people can start to get more optimistic. I think everybody is looking for some silver linings, a sense of breathing after a couple of really carnivorous days. At this point, though, even though Max Kettner of HSBC says that we have now entered thoroughly oversold conditions, people are trying to buy this, and they just can't get the confidence to quite do that.
Where's the circuit breaker? Bob Michael of JP Morgan Asset Management joined us for some special programming yesterday evening and made the argument the Federal Reserve won't make it to the next meeting. The next meeting concludes on May 7th. He believes they might have to move before then.
What would trigger them to move at a time when Jay Powell came out and said that he is squarely focused on inflation, and it is a different time now than back in 2018 because of the inflation we're coming off of? It would take a break in the system. That is what happened back in March of 2020 when Treasury started to sell off because it was a sell what you can, not what you want moment. Is there that kind of reckoning on the table that the Federal Reserve would have to respond to? And barring that, will they really move given that the backward-looking data still is really solid?
So pull up the bond board again. Let's go through it. 2-year, 10-year, 30-year. Just focus on the long end. Front end's really simple. Federal Reserve rate cuts, growth declines, all of that. Further out along the curve, it gets more interesting. 30-year yields are higher by 2 basis points. Tens are barely moving. 397 against the backdrop of an equity market that plummeted overnight.
This is fascinating, and you're right to pick this up. What is this suggesting? Is it people boycotting the United States and longer-term treasuries? Is it them not acting as much as a haven? Is it people selling what they can, not what they want? Or is it that we are in a new paradigm where globally, ex-US, everyone else is raising money for fiscal stimulus, and the United States might have to do the same, and even if they don't, the fiscal overhang from the deficit is significant enough to raise some concerns about how much confidence people can have to go into the long end.
A lot to work through this morning. Equity futures on the S&P down by around 2 percentage points. Coming up this hour, we'll catch up with Dan Scully of Morgan Stanley as the market round continues. Kamaksh Trivedi of Goldman Sachs on why he sees the yen as a top hedge, and the former senior Trump trade advisor Kellyanne Shaw as the president tells markets to take their medicine. We begin this hour with US stocks lower following the biggest two-day plunge since 2020. Dan Scully of Morgan Stanley staying cautious and writing the following. The tariff announcement has materially changed the outlook, which has created real technical and fundamental pressures for the market. While this remains a fluid situation, it will take time to resolve. Dan joins us now for more. Dan, good morning.
Good morning, John.
What phase of the sell-off do you think we're in right now? How would you describe this moment?
John, it feels early still. It's volatile. We've seen a lot of deleveraging by the hedge fund community, so we're down to low 40s now on net leverage. You typically don't see a capitulation bottom till a 3 handle is in that number. We still haven't seen retail really selling dramatically. If anything, retail was buying last week in size. So we think we're still early on, John, and as you mentioned, 48 hours to go until the deadline.
It's kind of amazing to see one of the biggest policy shocks, in the words of many economists, that we've seen in the last century, and yet GDP forecasts have been downgraded something like 1 percentage point. Can you reconcile those two things?
We still don't have really clarity in terms of whether or not we're going to collect, what tariffs are really for, whether or not we're going to collect on tariffs, whether or not there's going to be negotiations, and whether or not the consumer, which has been dominated by the high end for 2.5 years, is really going to be affected as much as the low end. So we truly don't have clarity just yet.
What do you think is going to lead on the way up, given that Magnificent Seven has been the hardest hit since their highs over the past couple of months?
We got to remember, Lisa, that Magnificent Seven is something like 55% of profits coming from overseas. So while they have a lot of secular AI-driven growth, they also tend to have a lot of international-driven growth. So we don't really see Mag 7 coming back to the fore if these tariffs stick. We see actually more domestically oriented industries, financials, healthcare, software and media being some of the more preferred industries to look at, particularly given the ongoing uncertainty of tariffs.
How concerned are you? We started this conversation, we started the hour, John mentioning the 10-year and the 30-year yield, and how it wasn't responding the way that it has traditionally with a hard rally of people buying as a haven. What's the signal you get from that?
It's an excellent question and observation. And look, our folks are expecting inflation to accelerate, actually, closer towards high 3s, 4% this year. So I think it has to do with the fact, in terms of the tariffs being passed on, in terms of a tax, and whether or not that will ultimately lead to higher inflation. And so we've been trying to think about, how do you ultimately diversify? If stocks are in a sell-off, if bonds aren't being the ballast that one would assume, we've been thinking more and more about themes, frankly, that we've been talking about for some time, related to real assets, related to privates. Frankly, this is not a bad time for investors to start rethinking their public market exposure, and maybe some opportunity to hide out in illiquid-oriented privates.
Does that include their international equity exposure? Because that is where a lot of people sought diversification in 2025. Overnight, the Nikkei down by almost 8%. Lisa mentioned the Hang Seng down by 13. The DAX at the moment, as we speak, is down around 4. What do you do with those longs that people piled on at the start of the year?
John, you referenced at the outset this ability of reaction function for international, and I would just highlight that we do see rising signs, whether it be China or Europe in particular. They do have the ability to do fiscal stimulus and to generate some type of domestic demand function. So we would say to folks, don't abandon some of that international diversification just yet. Keep in mind there was a long holiday, so people are now just catching up to some of the news from last week in the U.S.
Well, I just want to go back to this point that you're making about public markets not being a haven in any capacity, even in developed market debt, and that private markets offer some sort of offset. Are you saying that you could see public market, developed market debt not act as a ballast, and it wouldn't ripple through to the rest of the economy in a pretty profound way?
It could in the near term. I mean, it's an excellent question. What we're just saying for our wealth clients who tend to take longer term oriented investments and who have been candidly underallocated to privates for many years, that the disruption going on right now in the public world may be a time just to sit out for some time and think about their broader goals and broader plans to get exposure to some more idiosyncratic performance via private market horizon over a longer-term time frame.
How much, just when you talk about the international exposure, how much when you talk about inflation is that a global phenomenon? And does it stem not only from trade barriers, but the likelihood that we're going to get some sort of fiscal impetus from Germany, from China, from elsewhere in Europe?
I mean, I think when you look at some of those other markets, inflation has been elevated, but it certainly hasn't been maybe as pronounced as in the U.S. I think China has been exporting deflation for many years now. And I think the reality is that they've been holding their cards pretty close in terms of stimulus, but they have signaled overnight they're willing to do more rate cuts, willing to do more fiscal to stimulate domestic demand. So they're clearly saying that they have room to go and they're not as concerned about inflation.
We've had the China shock once, started 25 years ago. Huge disinflationary forces gripping the global economy. Is the rest of the world about to get a second China shock? If the walls go up in the United States, are we about to get another disinflationary bust worldwide?
I think it certainly could be, John. I think the question is how long do the walls stay up? And I think the reality...
You've got your doubts. It's the second time you've gone there. Where do these doubts come from?
Well, I think the reality is that we ultimately saw tariffs as a risk, but we saw them more as negotiating tactics. And so we're not necessarily sure that you don't have some détente in terms of particularly some of the East Asian countries who have incredibly dominated export growth. And so whether it be via currency changes and devaluations or maybe coming to the table on some of the current tariff levels, I think there's still some hope that things may change in the next several weeks.
I'm smiling because I find it amazing. Here we are, 2 days out from reciprocal tariffs kicking in, 20% on Europe, 34% on China, baseline tariffs already in over the weekend, and we're still sitting here on Wall Street having a debate as to whether these are negotiations or the new rules of the game.
It begs the question, where would markets be if people believed that these were the new rules of the game? That is ultimately the question that I have at a time where clearly there are many people who believe this is still just a negotiating tactic.
Dan, can you help us answer that question?
Well, I think it really also depends on the point and the direction of travel we're coming from in the U.S. I mean, we were coming from a point of 3% plus growth that was largely government and fiscal oriented. And so we're taking a tremendous amount of near-term painful medicine to try to reorder things that had been in place for many years. So I don't want to diminish by any means the gravity of the moment and what's going on. I also just think that we were playing with, or we had a starting point of fairly decent cushion to begin with.
Just to be more specific, how much more downside is there on U.S. equity markets if these tariffs are not negotiating tools, but they are actually the ultimate goal?
If they're the ultimate goal, then we have to reset earnings much lower. So if you just do simple math, earnings could be washed out this year. We were expecting 10% earnings growth at last glance before the last several weeks. So if you had zero earnings growth and multiples reset lower from that, you could be dealing with probably another 5, 7, 8% downside from here in the S&P. Now, who knows as well how delayed a tax deal would be. That could certainly be something that could change sentiment on a dime. So we're waiting and seeing with a very close eye on all these things.
Certainly part of the conversation over the weekend. Dan, fantastic to get your view on things. Thank you, sir.
Thank you.
Dan Skelly there of Morgan Stanley. Equities recovering a touch. We're down by 1.8%. So, new rules of the game or negotiations? Neil Dutta, his take. You either think tariffs are a means to an end or an end in and of themselves. The sooner everyone realizes that it's probably the latter, the sooner we can start talking about getting back in to this market.
Because we've heard that from the president, we've heard that from a lot of people. The idea of tax cuts as an offset, I think, is going to get increasing attention. You are seeing that as a parallel down in Washington, D.C. The only issue with that is this is an extension of what's already in place. Are they going to add additional sweeteners, and can they afford to do that in a way that truly does offset sentiment in some sort of material way?
We'll get the view from Anne-Marie in Washington, D.C. in just a moment. In the meantime, let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Traders are boosting expectations for Fed rate cuts this year, now pricing in 125 basis points over the next 12 months. Swaps at one point priced in 40% odds that the Fed does an emergency 25 basis point cut next week before its next scheduled policy decision on May 7th. President Trump was close to an agreement with ByteDance over the TikTok ban in the U.S. Sources telling Bloomberg that the deal was called off after China withheld its approval following the announcement of reciprocal tariffs. On Friday, President Trump extended the deadline for the sale of TikTok's U.S. operations for another 75 days. And in sports, the University of Connecticut's women's basketball team won the NCAA women's basketball title again. The Huskies defeated the South Carolina Gamecocks 82-59 to capture their 12th title. The Huskies now stand alone as the most winning team in college basketball history. Their 12 NCAA championships are easily the most in women's or men's basketball. And that's your brief, John.
Hey, Danny, thank you. More from Danny later this hour. Up next on the program, the president isn't blinking.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. I don't want anything to go down, but sometimes you have to take medicine to fix something.
Wall Street's taking the medicine. Equity futures down another 1.6% and recovering. Henrietta Trays of Veda Partners joins us next, live from New York. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
The message from the president this morning, the Federal Reserve should cut rates. Equity futures at the moment down by 1.8%, recovering a touch. We're down by 2 percentage points on the NASDAQ. Check out the bond market. We are pricing in those Fed cuts. The 2-year yield is down by another 7 basis points. On the 10-year, though, just about unchanged on the session. Lots of coverage of that maturity throughout this morning on this program. The 10-year, 398.85. Under surveillance this morning, the president isn't blinking.
Because of the tariffs, we have $7 trillion already committed to be invested in the United States. What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. I don't want anything to go down, but sometimes you have to take medicine to fix something.
Here's the latest this morning. Trump and his economic team remaining defiant, backing sweeping global tariffs, insisting an economic boom is on the horizon, even as global markets melt down. Anne-Marie was on Air Force One right in front of the president when he made those comments. Anne-Marie, he is not blinking. He wants Chairman Powell to do some of the work.
He does want Chairman Powell to do some of the work. He reiterated that this morning in a Truth Social post, talking about the fact that oil prices are down, interest rates are lower. It's time, he says,
for the slow-moving Fed to cut rates. Jonathan, on the way down to Palm Beach over the weekend where the president was, he also talked to reporters. And at the very end, I asked him again, what do you think the Fed should be doing as money markets are now pricing in more Fed cuts? And he said, look, I love that interest rates are coming down. I like that gasoline prices are coming down. This is the message he wants to project. He does not want to talk about equity markets. He made that very clear to me yesterday on the way back to Washington, D.C. when I asked him, is there a threshold? Is there a threshold of pain this administration is unwilling to tolerate when it comes to the tariff regime? And he said, look, I don't want anything to go down, but sometimes the medicine has to be prescribed, and that's what we're seeing right now. And it seems like they are willing to hold when it comes to this tariff plan and those tariffs coming in April 9th.
Anne-Marie, it's one thing to take a look at what's going on in equity markets. It's another thing to take phone calls from executives around the country saying, hold on a second, think about what you're doing and tell me what your actual plan is, because it is hard for me to figure out how to arrange my business. Anne-Marie, is there any sense that this White House is aware or concerned about some of the feedback they've been getting from the corporate community?
Look, I think they're very aware. Just look at what's also going on X, on Twitter, with Stan Druckenmiller and the likes of Bill Ackman coming after the administration, saying that the tariffs are just too aggressive. The president, though, on Air Force One did tell us that he spoke to about 4 or 5 tech executives over the weekend. He seemed to think that, at least what he told us, that some of them like what he's doing, standing defiant and trying to fix these imbalances. Really, the message I took away from that gaggle with the president is that there seems to be a new line in the sand, a new red line when it comes to what they want out of this, when it comes to the tariff proposals, and that's to eradicate trade deficits with the United States.
Anne-Marie, they couldn't have been clearer over the weekend. Appreciate your time, as always. More from AMH later this hour. Equity futures at the moment down by 1.9%. To build on this conversation, Henrietta Trays of Veda Partners joins us now for more. Henrietta, welcome to the programme. Nouriel Roubini was with us last night, and Nouriel made the argument that we're in a three-way game of chicken. Trump, Xi, Powell. And we asked the question, Henrietta, that we're going to ask you. Who blinks first?
Yeah, I mean, the weakest link there and the efforts that are existent on Capitol Hill around pressuring President Trump are virtually non-existent. I don't get any indications from any of our contacts over in China that President Xi is planning to do anything other than continue to challenge and go tit for tat. And that creates a very difficult dynamic for Chairman Powell. But I want to stress to investors this morning that there is no activity in Capitol Hill around restraining the president in any meaningful capacity. When you're excited about 6 or 7 Republicans in the Senate who used to be pro-free trade and oppose tariffs, signing on to legislation that in 60 days might act to restrain him, you're nowhere. So there is not an external pressure catalyst on President Trump right now to pull these tariffs back. And we should operate as though they are real and get over this idea of this being just a ploy. This is real. It is happening.
Henrietta, can you elaborate on that? Because this has been one theory that's posited, that maybe some of the Republican congressmen could come out and take back some of the power of issuing tariffs. What makes you confident that that's not going to happen, given some of the feedback that some of the constituents are getting, that some of the Congress members are getting from their constituents?
You know, I talk to members and their staff all day, every single day. I spent the weekend with them as well as with investors. And there's sort of this incredulous feedback loop that there is going to be some sort of movement on the House Republican side where their main source of consternation right now is the Senate budget, not any of the tariffs, despite the fact that when they go home, it's a huge issue. And the thing that I would tell investors this morning is you have 4 days. They're going to be in session Monday night, tonight, Tuesday, Wednesday, Thursday, and then they're gone until the end of April. So unless and until the market or your voters back home can send you a message, you literally have 4 days, and then it's off to the races for President Trump with no restraint for the rest of this month. And that is a lifetime in the markets. And I cannot find a single member who's willing to do any sort of material protesting to call this all off. And it's not going to be enough to, you know, reduce tariffs on Vietnam or reach a deal with Indonesia. That's not going to cut it. We are fundamentally reshaping the global trade economy, and there's no movement in D.C. to pull the president back from the ledge that he's walking us off.
Henrietta, just taking a look at the legislation that they are focused on, what does it look like in terms of the potential offsets to what some people are calling a tax on consumers by the levies? Is there a commensurate tax cut that goes beyond the extension of what we got during the last Trump administration?
There's not, Lisa, and I think this is the most important thing to focus on because it's the next pile-on question. Whenever you are unwilling to acknowledge that the tariffs are real, you say, oh, but there's going to be fiscal headwinds. The fiscal headwinds that exist in the Senate budget and the House budget are trillions of dollars in deficit increases from extending existing rates, a desire to cut an additional $1.5 to $2 trillion in entitlement spending across Medicaid, Pell Grants, food stamps, and TANF. And then there is an effort to pick little tiny pockets, like raising the cap on the salt cap, raising the deduction on the salt cap to $25K from its current $10,000 rate. That is not sufficient to offset the trillions of dollars in losses and hikes to consumers from these taxes in the form of the tariffs. There is maybe, and I've done the math, a million different times now, maybe about $300 billion worth of new stimulus that you can get into the economy. That's not going to cut it. That doesn't even spread around to the 350 million Americans that we have in the country. So there's no stimulus that will offset the scale of these tariffs.
There are some people in the Republican Party that get it, some people around the president that get it too. Henrietta, we heard from Senator Cruz, who's warned about what this could do to the economy. And there appears to be some emerging discontent within the ranks, within the White House, between Elon Musk and the likes of Peter Navarro. Elon Musk is out on X this morning, posting videos of Milton Friedman arguing against tariffs. Henrietta, is that one to watch? How do you think it's going to play out in the coming days?
Where was Elon Musk 2 weeks ago or 2 months ago when we were crafting this entire strategy? Everybody comes on and says it, but if you followed President Trump on the campaign trail or in the first term, the resolve and the belief in these tariffs is overarching. I would say, watch the EU auto sector. This is an area that he has fundamental core disagreements and believes the United States has been taken advantage of. I see no scenario where the entire auto sector is not upended because these tariffs go into effect. And it's so entrenched in the street right now that there's a view that there's going to be an auto bailout. So you mentioned Ted Cruz. I cannot fathom Ted Cruz crafting an auto bailout for the U.S. auto sector as President Trump puts 25% tariffs on the EU or Japan or Korea or Canada or Mexico. It's not in their DNA right now. And I would also go a step further and say almost 80% of the House Republican Conference was elected in the wake of TARP, in the wake of the auto bailout, and they got elected because they ran against it. So this fear or this hope that there will be, a stimulative effort or a bailout for farmers is one thing. We'll see that. But for individual sectors, as we get deeper into this trade unwinding, you're not going to see bailouts from the likes of Ted Cruz or, I think, most of the House Republican Conference.
Henrietta, appreciate your take. Thank you. Henrietta Trace there of Fader Partners, 2 guests in the last 20 minutes. Are these the new rules of the game, or is this the start of a negotiation? Henrietta Trace, new rules of the game. Dan Skelly, Morgan Stanley, potentially a new round of negotiation.
We talked about this with Neil Dutta last night. Why is it that this market doesn't believe that this is actually the new rules of the game and that this is simply a negotiating tactic? And he said markets like free trade and they can't imagine that anybody else doesn't. And that seems to be the sort of rude awakening that we are seeing this morning. And a real question, what does this market look like when people realize this might be just the new rules of the game?
We've got competing visions around the president as well. Elon Musk hopes this ultimately leads to freer trade, negotiate. Secretary Besson speaking to Tucker Carlson, articulating a grand vision that included tariffs, rules of the game, or negotiation. That's the judgment call. In the meantime, this equity market keeps gapping lower. We're down 2% on the S&P. Up next, Kamaksha Trivedi of Goldman Sachs from New York. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
You've heard it repeatedly over the past few days from the President himself, the Treasury Secretary, that the focus is shifting from Wall Street to Main Street. We'll see how this works out for Main Street. But the message from the President over the weekend, very clear to Wall Street: we need to take our medicine. And overnight we did. Equity futures dropped as much as 5% on the S&P 500 this morning, down by 1.9. We're 2 hours away from the cash open. Let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. The most traded stock this morning perhaps should come as no surprise. It is NVIDIA, with volume surging and trades to the downside, down 3.6%. Torsten Slok of Apollo writing, it's not surprising Mag 7 is under pressure. 50% of their earnings come from overseas compared to 40% for the rest of the S&P 500. Hedge fund darlings in general also getting slammed with reports of margin calls. Also under pressure, it is not just tech, it is also the banks. Goldman Sachs down more than 2.5% after already an ugly past 2 days. Morgan Stanley downgrading the stock, saying that this is the bad kind of volatility. It is bad for their investment banking, it is bad for management fees, so that's why they are under pressure. Now, if you want to find a stock that's doing well today, it's difficult to do, but I do have one for you, and that is Dollar Tree. Those shares up 1.2%, one of only 14 stocks in the S&P that are higher in the pre-market. Citi gives us an upgrade, moves it to buy, saying that they have a little bit of space to rise prices. In a world where all retailers are raising prices because of tariffs, names like Dollar Tree benefit because value-oriented consumers will still go there, even if tariffs mean that prices need to push higher, John.
Danny, great work, as always. Danny, on some of the single names to watch for this morning. Equity futures recovering just a touch. Session highs in a session like this one is down 2%. Go figure. On our radar this morning, President Trump striking a defiant tone on tariffs, telling market participants, quote, sometimes you have to take medicine to fix something. Trump defending the rollout, saying he won't strike any deals unless they eliminate trade deficits.
This is the difficulty for so many different people. Where are the off-ramps right now? We keep talking about this. You mentioned it's a three-way game of chicken. That's what we heard about from Nero Rubini yesterday. Trump isn't backing down. Xi Jinping, from all accounts, isn't backing down and is ready to go for tit for tat. Powell has come out, made his comments clear. So at what point is there some kind of earnings call that could potentially shift the logic, or do we have to start pricing this in? This is the reason why I thought the most crucial quote came from Deutsche Bank, from Jim Reed and David Fokerts-Landau, saying the next few days are going to be monumental for the global trajectory of markets in the years to come.
On Wednesday, the president said promises made, promises kept. His intention was pretty clear, to go big on tariffs in the campaign. Drew Madison MetLife wrote in moments ago and said the president promised reciprocal tariffs. Now, reciprocal tariffs was something very different to what we actually heard on Wednesday, which was a very crude methodology that was all about trade deficits. So it feels like with this administration, comparative advantage is just totally out the window. That if you have a trade deficit with us, somehow you have cheated. And therefore, we need to get that back down to zero. And I think Vietnam's a fantastic example of this. If Vietnam comes to the table and says, we'll get rid of all our tariffs, whatever's left of them, do you really think they can close that deficit, close that surplus they have with the United States? No, of course they can't. They can't import enough from the United States. That's not going to happen.
Right. So then again, what is the ultimate goal? And does it mean just simply isolating the United States in a way that would completely transform the way people do their business? One silver lining, and we talked about this, is the postponement of the TikTok deal. And the reason why I find this somewhat optimistic is because if there was any hope of actually reaching a deal, then they would postpone it. Otherwise, why not just cancel it altogether and ban it in the United States?
Where it leaves China, I think, is a major question. Do they devalue? Do they lean on fiscal? We had a big conversation overnight in Asia about them leaning on fiscal, maybe a little bit harder. What they do next is interesting to me. So all the overcapacity that people have complained about, all the overcapacity that was threatening to land on these shores in America, that's not going to hit America anymore. Tariffs are going to be too high. It's going to hit Europe. It's going to hit everybody else. What does China do from here?
Does it have an economic or some sort of military overtone? I mean, not to go there, but a number of different hedge fund managers, including Kyle Bass, talks about what this means for Taiwan and the geopolitics of the moment. Look, it is difficult to predict how this is going to play out. So a lot of people are saying, we're not going to because it doesn't make sense to keep going with this. So it's all going to get walked back. And that's the reason why a lot of people in markets just don't believe it.
This is only one part of the fuller policy platform. The other big piece of it, taxes. The Senate is advancing President Trump's tax cut agenda and moving towards increasing the U.S. debt ceiling. The budget resolution passing Saturday now allowing congressional Republicans to extend Trump's 2017 tax cuts. You ask the question, everyone's asking the same question. Is that enough? Can they? And are they willing to go even further?
And right now, the answer is it's not being embedded in that plan. If you think of a $25,000 cap to SALT deductions, that isn't going to cut it, as we just heard from Henrietta Trey's. This isn't actually some sort of stimulus. This is an extension of the status quo. At that point, how much of an offset could this be? We heard from Dan Skelly of Morgan Stanley that this could potentially shift the sentiment on its own. Can it?
Lower interest rates would be an offset. Lower commodity prices would be an offset. We're certainly getting lower crude prices. Crude breaking below 60 in the last day or so. Yesterday evening, 59 handle on WTI. The drop coming as Saudi Arabia cuts its selling price for May by the most in over 2 years. This just days after OPEC Plus announced an unexpectedly large output hike. So we've got two issues colliding with one another. The threat of softer demand colliding with the reality of maybe additional supply.
So what's the why here? And I spent a lot of time over the weekend trying to understand what Saudi Arabia's motivation is. Is it an olive branch to the Trump administration to say, we're on board with you to bring down oil prices? Is it trying to punish some of the OPEC members for producing more than their quotas are and saying that we're going to take away some of your profitability? Is it to solidify their role in global markets? Or is it in response to something that they see coming down the pike? Either way, oil prices are going down, yes, but not necessarily for the right reasons or as a reliable tell about what that means going forward.
We've seen them fight for market share before, and I wonder if that's what's happening now. Brent right now is at 64, WTI at $60 and about 60 cents. Let's turn to foreign exchange. Goldman Sachs expecting the yen to strengthen to the low 140 levels against the dollar this year. Global FX and interest rates head Kamakshir Trivedi saying the yen offers investors the best currency hedge against increased recession chances. Kamakshir joins us now for more. And there's certainly increasingly odds of a recession on the cards here, Kamakshir. And I just wonder whether you still believe that is the best hedge for this moment.
Good morning. Yes, I do think that the yen is one of the best hedges in this type of environment. We have long maintained that the best environment for the yen is when U.S. equities and U.S. rates fall together. And yes, they have fallen a lot already in the past week. You had some monumental moves in the last couple of trading sessions. But even with these levels, for example, of rate shifts, you're still above the levels where you were, for example, in August last year when recession risks were thought to be pretty high. You know, we think that recession chances are higher now than they were at that time. We raised our probability of recession to 45% over the weekend. And in that type of environment, when you're seeing U.S. equities, U.S. rates go down together, the yen tends to outperform. There's also a more micro reason, which is that if you look at the last few days, the dollar-yen exchange rate, in fact, has actually done less than you might have expected given the move in the rate differential between the U.S. and Japan. And so I think that's another reason why we think the yen is a very good hedge for the kind of macro environment and the market sessions we are likely to be in the coming days.
Kamakshir, what about the rest of G10, ex the Japanese yen? Let's just sit on that for a moment. Typically, if we reprice the global economic cycle and price it for a recession or an economic downturn, we'd start to think about broad-based dollar strength. Do you believe it's different this time?
I do think it's different this time. I mean, what you're referring is to the left tail of the dollar smile. We think we are a little bit away from that. If you look at how the markets have priced things, month to date, week to date, it has been very much in the nature of a U.S. growth shock. You've seen this kind of very dramatic increase in business uncertainty, consumer uncertainty, primarily in the U.S. on the back of, what looks like a trade war. You've also seen a very significant tightening in financial conditions. And so, given the dollar's strong valuation, given the sustained and large-scale positioning in dollar assets, we think that that is still likely to be the primary channel of adjustment here. We think that the weakness you've seen in the dollar can persist, can deepen further against the rest of G10. Yes, there is some risk that if this, U.S. shock morphs into something that is much more liquidity-driven, market stress-driven, that, then goes on to the rest of the world, that you start edging into the left tail of the dollar smile. But I still think we are some way away from that.
How much are you taking some signal right now from the fact that, as we've been talking about all morning, we haven't seen as big of a rally into the long end of the U.S. yield curve, even now, than many people would expect, given the risk-off tone in equities?
I think that is important. And I think that, in a way, normally you would think that that is the buffer or the offset, if you like, to some of the shocks that you're seeing. But I think it is, again, the nature of the shock we're facing. The complication with the tariffs is that not only do they cause this uncertainty that sort of compounds the risks that, make us worry about recession, but they also raise prices, that you see inflationary impacts from them. And so that puts the Fed in a much more difficult position. Now, we do think that, if you see a kind of broad-based and deep deterioration in the labor market, you will see rates come down. But I think you're going to have to be more patient for that. So not just the put from the administration, but the put from the Fed also feels that much further away. And that, I think, makes the path for equity markets, for risk assets, that much more complicated.
Kamakshia, we've been talking about potential circuit breakers again and again. It's not coming from Jay Powell. It's not coming from Donald Trump. It's not coming from Xi Jinping. Is there a circuit breaker that is actually the circuit breaker, that is fissures in a market that ends up dysfunctioning and requires some sort of response? Do you see any signs, any evidence that could be happening even on the margins?
I think so far, you have seen some circuit breakers in some markets and so on, but, by and large, you've seen a kind of broad-based pressure, that has been, relatively, orderly. It's always hard to use that word to describe the kinds of moves that we have seen, which, as I mentioned, are truly historic. But, again, the dollar move lower, it's been going on for some time, even before, this latest round of reciprocal tariffs were implemented. You've seen some pressure on the equity market also predate this, but there's no question that, if we see, a compounding of these risks from the kind of weak level of growth you're already starting at, that you could at some point see the kind of market pressure that, leads to the kind of situation you're describing, one where stress levels, liquidity, illiquidity pressures start to come in and start to build up. We aren't quite seeing that yet, but it's still early in the week.
Can we just build on that? That word orderly. If this is orderly, what does disorderly actually look like?
Yeah, I think, you start to see the kind of breaking in the market stress indicators, some of the liquidity indicators that, you typically look at this type of, when you have these kinds of measures. That's why I mentioned, I think that, if you see the continuation of this, there is still, I think, some hope, some risk out there that, before the 9th of April, you see some walking back, or perhaps the full set of tariffs that were announced maybe don't go into play. But I think if that does happen, as has been announced, I do think it's going to be hard to avoid, further moves down in the market. And at that point, it could start to become disorderly.
Kamakshia, appreciate your take as always. Thank you, sir. Long week ahead of us all. We've said that repeatedly. Kamakshia Trivedi there of Goldman Sachs on the Federal Reserve and what it would take for them to reduce interest rates. Colby Smith out of the New York Times at the moment, just writing that perhaps put more data than this market believes, Lisa, and that it might take a while to get sufficient evidence that the hard data is broken for the Fed to step in, which could mean this Federal Reserve moves much later than this market anticipates. As for the market stress. So we've reminisced about what happened back in late 2018 when we saw high yield spreads gap a lot wider. What we also saw in December of 2018 was the high-yield market totally seize up. Not a single issuer came to market in the United States that month, and that woke up the Federal Reserve. They're the kind of things to watch, I think, this time around as well.
We are seeing credit widening continue for a third day. If you look at some of the derivatives contracts, at the same time, people are ratcheting back their expectations of some sort of Fed response. Either way, to Colby Smith's point, right now, Fed funds futures pricing in about 4 Fed rate cuts by the end of this year. Watch this space when we hear from the Fed's Kugler later this morning, and a whole host of Fed speak throughout the week.
The next decision on May 7th from the Federal Reserve, and May 7th feels like a lifetime away. Equity futures on the S&P 500 negative by 2.4%. With an update on stories elsewhere this morning with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs economists have raised their 12-month recession probability, now at 45%. They've also lowered their GDP forecast. They also expect the Fed to deliver 3 consecutive 25 basis point insurance cuts beginning in June. A check on Tesla stock extending losses this morning, down 6.5%. At one point, it dropped below a price that Commerce Secretary Howard Lutnick predicted that they would never fall to again. He made the comment on March 9th on Fox News when Tesla closed above $235. Lutnick encouraged viewers to buy the stock at the time. And the weekend box office got a much-needed boost from a Minecraft movie. The film, based off the namesake video game, smashed its opening weekend, earning a staggering $157 million in ticket sales from the U.S. and Canada. It was the best opening for a movie so far this year. That's your brief, John.
Danny, thank you. Appreciate the update. Up next on the program, sticking with the game plan.
There is no postponing. They are definitely going to stay in place for days and weeks. The president needs to reset global trade.
That's what he's attempting to do. Up next on the program, the former senior Trump trade advisor Kellyanne Shaw, live from New York City. You're watching Bloomberg Surveillance.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
This right here is what calmer waters look like these days. Equity futures down 2.5%, down 5% overnight, down 6% Friday. On Thursday, down by 4.9%. The biggest sell-off we've seen going back to the pandemic. On the Nasdaq, down 2.9% on the session. Under surveillance this morning, sticking with the game plan.
There's no postponing. They are definitely going to stay in place for days and weeks. The president needs to reset global trade. The countries of the world are ripping us off, and it's got to end. The president has made it crystal clear. This is the policy we are going to protect. The factories that come build in America, we are going to protect them. They're going to be successful.
So here's the latest. They're sticking with the plan. 10% baseline tariffs already active. Reciprocal tariffs kicking in on April 9th, just 2 days away. Joining us now from Washington, D.C., Bloomberg's Anne-Marie. Anne-Marie, good morning.
Good morning, Jonathan. The White House defiant and really digging in when it comes to their tariff proposals. And those tariffs are set to take place. And one thing was very clear when the president was gaggling with us reporters last night on Air Force One, and I was there. He said, I'm willing to make a deal when it comes to China, but they have to solve the surplus. This has now become a line in the sand for this administration. Trade deficits. We have one of the most important people to discuss this morning, Kellyanne Shaw. She's a former senior White House trade advisor, so really can try to help us understand, read the tea leaves of what's exactly going on. I asked the president yesterday a few items, but one thing when I asked him was, is this a negotiating tactic? Is this the start of deals, or is this rules of the road? These tariffs are here to stay. And he didn't want to answer. What do you make of that?
Yeah, good morning. And I think it's really interesting that of all of the 6 cabinet level officials who went out on the Sunday shows yesterday who were asked the exact same question, they all punted on that as well, right? So this is the message coming out of the White House. We're going to keep it ambiguous. We're not going to tell you exactly what's going on. And part of that, as a former U.S. negotiator, is that if you really are negotiating and that's your bottom line, you don't want to broadcast that to the world. And so my read on this is that the president is keenly focused on the trade deficits, that 10% global baseline tariff is intended to stay with respect to almost all of our trading partners for the foreseeable future, but that there is negotiating room on some of those higher tariffs, provided countries are willing to come to the table and fix not just tariff but non-tariff barriers.
So the ambiguity helps if you're someone like you in Trump 1.0. You're at the table and you need leverage negotiating a deal. But how much pain do you think they are willing to really withstand in the financial markets to get to that endpoint?
Well, I think it depends. And so right now, all of we've seen so far in terms of the president's economic agenda are these tariffs. We haven't seen the tax cuts. We haven't seen the deregulation, at least the total implications of everything they're doing. We haven't seen cuts to fiscal spending. We've seen energy prices going lower. The administration will point to the jobs figures, which were very good last month. So they're hoping they can ride this out. And the president's asking the American people for a long leash. And that's what's happening right now. And we'll see if the American people give it to him.
Right. He's been saying this term, hang tough. It's going to be a little bit of pain. He said yesterday to me, sometimes you need a little bit of medicine, and that's what we're doing right now. Do you think any trading partner will be able to negotiate below that 10% barrier they basically put across the board?
Potentially. I mean, if you look at countries like the UK or Australia who have trade surpluses, or the United States has a trade surplus with, and there are specific issues, specific non-tariff barriers that the United States is concerned about. Beef in the case of Australia, some of the tax issues in the case of the UK, there may be scope for a deal there. But if you look at the legal basis for this measure, these IEEPA tariffs are based on the trade deficit. So I think countries with whom the United States has a trade deficit are less likely to get out from under some of these 10% tariffs than countries that do.
Do you think there's going to be legal challenges or congressional challenges to all of this?
Well, we've already seen the first legal case, at least with respect to the fentanyl tariffs, which was filed. And I would imagine that come April 9th, somebody is likely going to file a legal challenge to this next set of tariffs, these reciprocal tariffs that are going to go into a place. But, you know, the president has broad authority under IEEPA, and I don't think that the administration is particularly worried about these legal challenges, at least not yet. And on the congressional side, we don't have a majority of Republicans on the House who are willing to vote against the president, at least not right now. And I think that that majority will hold for quite some time. Now, at some point, that may run out, but I do think the president has a bit more in terms of political grace here.
The next step for trade for me would be potentially this phone call. Japanese local press is talking about a phone call the prime minister is going to have this morning with the White House. And then also Benjamin Netanyahu, the Israeli prime minister, will be at the White House. He met with Howard Lutnick, the commerce secretary, yesterday. Could we see deals as soon as, say, this week, or is that too soon?
Well, and that's something that's also interesting, too, in terms of what those 6 cabinet secretaries said on TV yesterday, that they all highlighted that over 50 countries had contacted the White House seeking some sort of deal. So clearly they are entertaining something. But the other message is that the issues that they care about, which are predominantly these non-tariff barriers, won't be fixed in days or weeks. So they're forecasting months into the future in terms of when we might see some of these deals. But if, again, there are specific issues with specific countries, I wouldn't be surprised to see a few deals evolve in the near term.
Do you have a list in your mind of who potentially could get the first handful of deals?
Well, I think certainly some of our major trading partners. So if you are a small country or an Antarctic island, you're going to be pretty far down the list in terms of the countries that the administration would be negotiating with. But their eye is going to be focused on countries like China, Vietnam, Malaysia, Japan, South Korea, the EU, some of the countries, again, with whom we have these large systemic and sustained trade deficits.
But some of those smaller countries, how do you get to balanced trade? Madagascar, I think it was a 47% tariff. Their capita per GDP is $500. In the U.S., the capita per GDP is, what, $80,000. How do you get to balanced trade with a country that is economically disadvantaged?
Yeah, I think some of these things are challenges. The perspective of the administration would be that we're a bigger economy. We should be exporting more to you than you are to us. But they have some choices to make. They're going to have some trade-offs. And for most of the countries in the world, it is this 10% baseline tariff, which I think most countries won't get out from under at the end of the day. But for some of the smaller countries, they're certainly going to have to try in terms of trying to negotiate some of these higher tariffs on down.
Kellyanne, thank you so much for joining us this morning. Jonathan, Kellyanne Shaw, former trade advisor during the Trump's first administration. Key takeaway from me, she nailed it right there. Everyone's punting whether or not this is a negotiation or, as you call it, new rules of the road.
We've had 2 different views already this hour, and there's another one for you. Anne-Marie, thank you. It's so hard to negotiate because of the crude methodology that was unveiled last week. What is the objective? Removing all your tariffs is one thing. Giving a plan to eradicate the deficit is quite another. It's very difficult to do the latter.
Yeah, given the fact that some of these economies are not feasible, cannot feasibly meet that goal, what I took away was the penguins, the seals are going to have a hard time.
I think if you're living on the Antarctic, you've got other problems, to be honest with you.
I don't know if there is
Maybe it's
anyone
not the
living.
morning for jokes, I don't know, but come on. Up next on the programme, Laurie Calvasina of RBC, Sami Sith of Raymond James, Michael Gapin of Morgan Stanley, and Megan Draper of Barclays. From New York, the 3rd hour of Bloomberg Surveillance. Up next.
Another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. it is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Financial markets are incredible discounting machines, and they're discounting the future story, and it's really about this tariff story.
If these tariffs stay, all bets off, because it changes the whole paradigm.
There is a hope trade, though, in the market. I think the hope is that this is the start of negotiation and that this is actually not going to stick.
Tariffs are going to be high, and I think they're going to be high for a while.
The hardest thing for the markets right now is not only to try to evaluate where the destination is, but how bumpy will the journey be?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The journey so far, and thanks for that, Mohammed, incredibly bumpy. Live from New York City this morning, good morning, 90 minutes away from the opening bell and that hope trade getting obliterated once again overnight. Negative 5% this morning off the lows, down by 2. On the Nasdaq 100, entering a bear market, down another 2.3%. In the bond market, pricing in more rate cuts at the front end of the curve. Yields lower by 4 basis points, 3.61. The 10-year unmoved. The surprise of the morning so far, the 10-year 3.9923. Even with these moves in the commodity market, crude lower again in 3 sessions, down around 16%. Down 2.5, back to about 64. A break of 60 overnight on WTI, $60.30. And a whole new list of downgrades on Wall Street. Massive list of them. Here's 3. John Stolfus, Oppenheimer. He goes down from 7,100 to 5,950. Evercore down to 5,600 from 6,800. And the latest to join that growing list, JP Morgan, coming out with this one. 5,200 from 6,500 previously. And Lisa, when you put it all together, when you look at all those numbers, what do they all have in common? They still believe this market ends the year higher than where we are right now.
That is exactly where I was going to go with that. They still are in the 5,000s, okay, as a base case, which is pretty optimistic considering where we are right now. Look, we have said this again and again. There is a battle brewing between Wall Street, which does not believe that these tariffs are going to stick, and policy analysts who are saying there is no reason to think that they're going to be backed off anytime soon. You put those two together, they're on a collision course, and frankly, it's the reason why people don't want to catch a falling knife, and you're still seeing losses after the worst 2 days going back to March 2020.
You see this in single names as well. Apple was down 16% in 2 days. That's something we haven't seen since 2008. And when you look across the coverage of the name, Rosenblatt, not just to pick on them, not picking on anyone here, It's hard for us to imagine Trump blowing up an American icon. That suggests something is likely to give. People believe that this will be so bad. Maybe it won't, but people believe it will be so bad that it just won't happen. And that's why they're clinging to this belief that it's a negotiation and not the new rules of the game.
And if you listen to President Trump, what he said was that the CEOs of tech companies called him up and said that actually stay hard. This is going to keep working. I think that what you're doing is right. So put these messages together and you don't get any kind of conclusive answer. Question going forward is, and you raised this really interesting question over the past couple of hours, what is going to be the consequence for U.S. markets going forward, given the fact that we are not seeing that rally in longer-term bond yields? I just want to put some perspective on this. Since August 2nd, we have seen almost 40 basis points of a rally in 10-year Japanese yields, almost 20 basis points in German 10-year yields, 14 basis points in U.S. 10-year yields. What is the pressure valve in the U.S. that can take some of the steam out of the system if it isn't necessarily a rally in long-end Treasury yields?
Nouriel Roubini said this is a three-way game of chicken. Trump, Xi, Powell. Powell going into the weekend not blinking. What would it take to get this Federal Reserve to come to the table? Because we're not seeing it just yet.
Something breaking. That is what people have said, and that's what happened back in March of 2020. Remember, they cut by half of a percentage point initially in response to the pandemic, and then another emergency cut down to zero subsequently, less than 2 weeks later, ahead of a meeting that they had planned. If they have that kind of response, is that going to be a positive for markets? Will that be a relief valve at a time when that doesn't necessarily consolidate the actual issue, which is, are we facing a new trade regime?
The opening bell, 1 hour and 26 minutes away. Equity futures off the lows, but still a whole lot lower. Coming up this hour, we'll catch up with Lori Calvasina of RBC on why her bear case is now her base case. Savi Sith of Raymond James as tariffs weigh on airlines, and Michael Gapin of Morgan Stanley on the likelihood of a global recession. We begin this hour with stocks lower following their biggest two-day plunge in 5 years. Lori Calvasina of RBC writing, we are lowering our year-end 25 price target to 55.50 from 6,200, essentially making our old bear case our new base case. Laurie joins us now for more. And Laurie, I have to say, that old bear case, which is the new base case, is sounding like the bull case based on the moves we've seen over the past few days. How you've reflected on things over the weekend?
It's a great question, John. I was actually talking to my energy trader, and the days are all bleeding together at this point. I think it was on Friday. And, you know, we sort of discussed how we went from stagflation in terms of people's thinking to recession in about 2 seconds. And I've never seen anything like it where you've just seen the mentality shift so much, so quickly. But I will caution you, that is what happens in growth scares. And that is what we are smack dab in the middle of. The 17.4% drawdown that we saw as of Friday was exactly in line with the average drawdown that we saw in 2010, 2011, 2015, 16, and 2018. Of course, that 2018 went all the way down 20%, which would take us to around 4,900 on the S&P this time around, I think just a touch under. And so this is what it feels like. You know, we have this tiers of fear framework we've talked about to help us navigate. We're in tier 2. Tier 1 is the garden variety pullback. Tier 2 is the growth scare. Tier 3 is recession. And so we have increasingly been talking to people. If we break through that 20% number, what does recession look like? If you look at the average and the median drawdown, it's about 27 and 32%. It's taking it to 4,200, 4,500 on the S&P. We could do that. It's not unreasonable to be thinking about that.
Laurie, we know how to price growth scares. We're okay at that. We're fairly decent at knowing what a recession might look like, though we haven't seen many over the last 20 years. That's a shock to the cycle. The issue that we've been trying to get our hands around is how to price a shock to the system. Because if these are the new rules of the game, this is a change we haven't seen for decades, Laurie. How different is that?
So I think it's a great question, John. And as I've been, you know, talking to investors over the past month, and we were talking about how that tier 2 fear was rising. One of the thoughts that occurred to me, and I didn't like to say this out loud all that often, but it had felt a bit to me like this was January of 2020, where there was something coming that we didn't quite know what it was. I will give you one bit of, you know, comfort from that 2020 period, which was that ended up being a garden variety recession in the 30s in terms of the drawdown for from peak. And I know it doesn't make us all feel happy for me to say that out loud right now, but it does give me a little bit of comfort. If you really want to talk about big crises, we don't have a big sample size on those. You know, we've got things like the tech bubble, we've got things like the GFC. You basically see the market lose half its value. I'm not saying that's what's going to happen, but as we sort of explore, you know, the depths that we could go, that is the one outside of recession that you want to look at.
You said, Lori, in your recent note that full recession pricing could be a drawdown of some 27 to 32% based on historical standards, which would take the index down to 4,200 to 4,500. What would you have to see to start entertaining the idea of that being a base case?
So look, I think the street, and we talked about this in our target note, we changed our target on Friday morning. It was clear to us on Thursday that you know, things were not going to hold in that garden variety territory. But the reality is that the street right now is really doing a lot of hard work modeling out what the economic impacts are. And so we've got the impacts from the tariffs, of course, but then we've also got secondary impacts, right? We've got impacts from all the uncertainty we've just had. We've got secondary impacts. Even if the tariffs get dialed down, there's still secondary impacts from the uncertainty that will be there going forward. This is a very, very tough thing for the economics community to model. They're working through it now. And I will remind you, Lisa, a week ago, we were also all sitting here saying we've seen all this deterioration in the soft data. What about the hard data? We still haven't really seen any hard data yet, you know, for the recent impacts of all that uncertainty. So we need that baseline to come out in this hard data to really understand what the damage is going to be.
At the same time that we're talking in these sort of catastrophic terms, I want to go back to the call that you actually made, which is gains on the S&P through the end of this year. What gives you hope or confidence that actually there is going to be some sort of rally? What is the relief valve that you think stymies what this is, as you frame, a growth scare?
So look, there are two things that you can look at. One of them I buy into, the other that I don't. I think that the thing that, you know, and we've seen strategists, you know, start to take their numbers down. A lot have not. And I think one of the reasons why a lot have not is because there is an understanding, if you've been in this business long enough, that as fast as you go down, you can rally just as fast on the other side once something happens, once there's some sort of policy intervention, once there's some sort of change. And so I think that's keeping people, you know, somewhat, I don't want to use the word complacent because that's not what it is. It's a legitimate thing to worry about. But I do think the trigger in terms of the fundamentals for that is this idea that we get back to tax, that we get back to deregulation, that somehow this storm passes and we get to the promised lands of those business-friendly things. I'm not so excited about that. But I will tell you the thing in my modeling, Lisa, that sort of keeps me sympathetic to that kind of V-shaped type move, or at least on guard for it a little bit, is the idea that if you look at AAII net bulls, they are a very, very good contrarian indicator if you're looking on a forward, say, 9-month basis or 12-month basis. And we are down more than 2 standard deviations below the long-term average. We have been there since the end of February in terms of how lousy people have felt. That is similar to what we saw in 2022. It's similar to what we saw in the GFC. It's similar to also what we saw in the 1991 recession. If you go back to the fall of 2022, there was despair running around the street. We had something weird happen with that inflation spike. It wasn't quite a recession. It ended up being a great buying opportunity that nobody, you know, could even entertain in terms of kind of writing the sentences out on paper. But that indicator, that just sort of contrarian impulse, I think is something a lot of people in the strategy community have in their minds.
Laurie, help us navigate the earnings still to come. So on Friday, we were going into the hard data looking for payrolls. Payrolls came and went. No one's talking about it. No one's mentioned it. For the whole of this morning, for the whole of yesterday when we did special programming, the payrolls number didn't even come up. We moved on quickly. This week it's about earnings. Are we going to have the same behavior towards earnings this week when we hear from Delta Airlines on Wednesday, from the banks on Friday? What would you use earnings this week for? Can they offer any guidance?
So John, I don't think that the earnings this week are going to offer much guidance beyond the banks themselves. You know, I think the airlines always give us some interesting clues, particularly in regards to consumer behavior. So, of course, we want to pay attention to that. But, you know, to be honest, the banks are not at the center of this storm. You know, we might hear some things in terms of trading volume and whatnot. But we knew, you know, back in early March at our financial conference that the banks were in pretty good shape. They were cognizant of what was going on, and they felt like they could manage through. So do we see any deviation from that message? That'll be one thing to look at. But really, really, John, what we care about is week 2, week 3, week 4. Week 2, we get more industrials. They're really more at the center of this storm. We need to hear what they're saying in terms of how they manage their supply chains and pricing. You're not even going to get consumer companies till the end of this reporting season. You might have a few sprinkled out throughout, but this can be a long slog. There's a lot of hard work to be done. Companies have done a lousy job of giving the sell-side analyst community guidance on how to think about tariffs, because that denialism you talked about, John, the companies have been guilty of this as well, and it's really frozen a lot of the people who cover stocks on the street, because when they don't understand what the sensitivities are, they can't model it. And I will tell you, I read a lot of transcripts. Companies have not wanted to talk about anything until it comes reality, and we're just now having that reality hit them in the face.
Laurie, you don't have to answer this question if you don't want to. I don't want to put you in a tricky spot. But do you think that could be because these management teams didn't want to get on the wrong side of the administration? Do you think that was something that was driving their decision not to share their thoughts on tariffs? And do you think that'll change in the coming weeks?
You know, it's hard for me to speculate on what that is. I do worry a bit, John, about financial markets. And, you know, I'm an old political science major. I studied political theory, and so I'm a big believer in the free marketplace of ideas. And I do think we have to have a free marketplace of ideas on the street for financial markets to work well. But I think, to be honest, they have really just not wanted to talk about things until they knew exactly what they had to talk about. If we sort of look forward, you know, I think the conversation is going to get started. But I will tell you, one of my analyst last week told me his companies, they're not going to be able to figure out this in one quarter. It's going to take a couple quarters, and that was not a comforting thought to me.
Laurie, appreciate your time, as always. Thanks for jumping on for us. Laurie Cavacina there of RBC. We'll hear from those management teams this week, and I think for many analysts, they'll just turn around on the call and say, well, these are the rules. 10% went in over the weekend, April 9th, because the bank earnings will come after April 9th. April 9th, the reciprocal tariffs are on. So based on that, what do you think happens from here? Now, you can sit here and say that we think there's going to be negotiation, but I think you've got to